All right. All right. Thank you all for being here and coming to this training. Um, I did my best to shorten this as much as possible and to cut out as much as I possibly could to make it so it's just not like a long training or presentation here. So hopefully, but I mean, you're still going to get a whole lot out of it. I just wanted for time's sake. I know a lot of people have a short attention span, so I just got right down to the nitty gritty of things, and we're just going to go through that. So first, anybody who doesn't know me, I am Ishmael Muhammad, and I am a financial literacy educator and also a business funding coach. So what I do is I help businesses, entrepreneurs, investors, or anybody that's looking to get their hands on capital to invest or whatever they're looking to do. I help them be able to raise that capital. Oftentimes, I am helping them raise it from scratch. They've never raised capital before. They don't know how to raise capital or the proper way to go about doing it, and especially the how to maximize and get the most money possible out of raising capital. So this training here is not going to be a consider any type of personal individual consultation. This is for informational purposes only. I do one-on-ones, and usually that will start with a phone call, just kind of get an idea of who you are, what you're looking for, and if this particular type of business funding works for you, right? So that is that there. So let's go ahead and get into it. All right. So some of the objectives we want to hit as far as in this training, one is we want to understand the severity of our financial situation. And this is not just our personal situation or maybe our business situation, but overall as a country, as a people, as our financial system, our monetary system, what exactly is going on, and understanding where we are and where we need to go and how we need to protect ourselves. So we want to adapt new mindsets, a wealth and abundance type mindsets. We're going to leave here with actionable steps that we can take to prepare ourselves to go out there to get funding for our businesses or for whatever we're looking to use this capital for. We're going to learn some methods of cleaning credit, getting our credit together. So that is something that many of us, well, most Americans, 80% of Americans are challenged with. So we're going to talk about a few techniques of how we can, get some things off our credit, get our credit, structure right, get it together, and so we can go to these banks and get this funding. Another thing we're going to talk about is how we're going to be leveraging the credit reporting agencies, how we're going to be structuring our personal credit and also our businesses for the maximum amount of funding. And then we're going to go into some methods and techniques of how we raise the six and seven figures per round, right? All right, so who is this for? This is going to be for, this is, I put this slide in here for a very specific reason. But this is going to be for people who are earning under $200,000 a year. Obviously, business owners that, earn more than that, this you can still get value out of this or take advantages. But for most people don't earn over $200,000 a year. So if you earn less than $200,000 a year, you have under or less than $1 million in assets, and you need capital for your business or whatever your investments endeavors are. Um, so if you don't know that only 18% of Americans actually earn six figures or more. And as a household, as a collective household, only a little bit over 34% of American households earn over $100,000. And out of those people who earn over $100,000 a year, actually half of them are actually living paycheck to paycheck. So people think that, once you reach 100 grand, like you're set, but that's just not true according to the statistics. All right. So anybody who is feeling like you're overwhelmed, you're feeling like you're stuck in life or stuck at a certain point, you can't get over a certain hurdle. Maybe you're fed up, you need a change, maybe you want to get out of your job, you're looking for something else. You're struggling to make ends meet. You're not earning enough money, not bringing enough money in. You have a lack of information and direction. So you didn't have really have those mentors, the rich dad, to help you kind of figure these things out and set you on the right path. You lack opportunities. So you may be in a position where you're not aware of the opportunities you may have or what's around you or if other options out there for you. You want control over your life. That's a big one. You want better options for yourself and for your family. So you're looking to see what else is out there. You have dreams, you have goals, you have ambitions, and obviously we're going to need some funding to make those things happen. So we're here in the right place for that. You need to get your business off the ground. So there's a lot of us that are have great ideas. We've registered a business and we just kind of left it right there. We didn't take it any further. We didn't do anything else with it. Just kind of sitting there in limbo. So we can get the funding to actually get that thing going that you want to do, right? Or you just don't know. You just kind of just unaware or just ignorant to what is going on, like what's out here, you know? You don't know anything about money or anything like that or financial literacy. You're just trying to get more intelligent, which I applaud you for. And you're on the wrong side of inequality, which is seems to be most of Americans these days. All right, so here are some of the stats. So 52% of Americans need 100K per year to be financially comfortable. This is what 52% of Americans believe. 50% of six-figure earners live paycheck to paycheck. 26% of Americans say they need more than 100K per year to feel financially comfortable. All 50 states in the US require you to make $100,000 for a family of four to feel comfortable. We know student loans are at an all-time high as far as student loan debt. 62% of millennials and 63% of Gen Z believe homeownership is the American dream. So they still believe in that dream. But 66% say inflation leaves them feeling hopeless about ever owning a home. And 72% say they cannot afford the down payment. 52% say student loans delay their ability to save, and over 25% of Americans are doomsday spending. So doom spending is when you feel like, you know, you really have no mobility, you're not going to, the situation is not going to change, it's going to just be like this. So whatever little additional money or funds that you get, you just blow it just for instant gratification. And then 73% of Gen Z say the economy makes them makes it difficult to set up long-term investments. So they feel like they need every single penny and they're not willing to part with anything to invest in the future, which is absolutely terrible. So some habits we want to get out of is we want to stop listening to people that aren't where we want to be. This can be family, this can be uh, celebrities, this can be friends, this can be anybody, this can be influencers, it can even be your teachers, you know. So we want to stop abusing your credit because credit is your access to new money. We want to stop being disorganized with our money. We want to understand what we're doing with our money, be good stewards of our money. We want to stop looking rich and being poor. This is something that I know a lot of people from the community. They do this very well. Look rich and be poor, right? But instead, let's put our money into vehicles that's going to spin off more cash flow, and then use that cash flow to go get the cars and the clothes and everything else that we like to, we like to have, you know. So, and then we want to stop being unprepared. So we know life happens. It kind of bothers me now that I have this understanding and awareness that, you know, we are when we tighten, we're going through things, we finally get a little bit of breathing room and then something breaks, the car breaks down, the refrigerator goes out, there's a hole somewhere, or, you need this, or somebody comes with, somebody dies, like something always is popping up, right? But just when you think you just got a little bit of breathing room, well, that's life, things happen and we need to be prepared, which means we need to have cash flow coming in, we need to have excess cash, we need to have access to cash, so when life is happening we can keep up with it. All right, so middle class generational curses. Um, this here, okay, so some of the habits and things that we do in the middle class that keeps us in the middle class and we never can get out of it, is that we spend too much time around poor people. And this is not just people as far as money goes, but like spiritually poor, financially poor, um, like educationally poor, mentally like just what we think about ourselves and life around us. We're just negative, like just poor mindsets, poor, just poor all around, you know? And you don't talk about money. You don't talk about opportunities of money, getting money, making more money. You don't talk about money. You use credit for debt instead of income. So that's something that we definitely need to stop doing. We can use this credit to get and buy as much income as we could possibly dream. You don't use leverage. So you want to do everything yourself. You want to be, by yourself, independent, doing everything on your own. Don't want to work together with nobody, you know. So you don't use leverage. You put your life into a job versus a business. So people who depend on the generosity or the what someone else is providing to them for their livelihood is a person that is in danger. So when you have a business, even if you're still working a job and you have a business, you are taking your life into your own hands. You're taking your future into your own hands. You have something to depend on. So if your employer ever decides to renege on their opportunities that they gave you, you have something of your own that you can produce with and take care of yourself and your family. So you don't own your own value. When we go to school, when we get this education, when we get training, when we learn all the different things, when we increase our value, we go give it away to someone else instead of using it for ourselves to make ourselves rich and wealthy. And you don't earn what you are worth. So no employer can pay an employee what they're worth. It is impossible. Impossible. No matter how much you're getting paid from your employer, how much raises they give you, bonuses they give you, commissions that they give you, different packages that they give you, they can never afford to pay you what you are truly worth unless they are willing to bankrupt their business. Because all the revenue coming in, instead of going to them, it'll be going to you, right? And they need that revenue to pay other departments to keep the business going, for expenses, But if they're paying you what you're worth, then the business won't have any income because it'll all be going to you, right? So you're not getting, you don't own your worth, you're not getting paid what you're worth. You pay too much taxes. The middle class pays the most taxes out of anybody. And it's not because of percentage of the taxes or this, that, and the other. It's because that the government it feeds off of you. It leverages wealthy people to do what they need to do to run the government and do different things that they need to do to get elected, to do all kind of different things, right? They leverage wealthy people and then they feed off of the middle class, right? That's where most of the taxes come from. So either the government is going to directly tax the people or they're going to put it on the wealthy to pass the tax increases along to the middle class. So anytime a politician talking about raising taxes on the wealthy, businesses, corporations, any type of that type of talk, they're basically saying, okay, we're raising taxes on the middle class, but we're not going to raise it directly on the middle class because we need to get elected. So instead, what we're going to do is we're going to give the burden to the wealthy to pass the tax burden down to the middle class. So no matter any taxes that ever gets raised, it all gets passed down to the middle class, either directly or they go through the wealthy to raise taxes on the wealthy so they can pass that tax burden down to the middle class. So the middle class is always going to pay the most in taxes. So if you ever want to stop paying the most in taxes, you better start understanding the value of a business and an entity, and living through that, or just get out of the middle class, raise your income, and get some assets. You depend on one income. This is a problem. We have multiple bills coming in, reoccurring bills, monthly bills, expenses every single month, but we got only one income. Why don't we have for every bill that comes in the mail, why don't we have a check coming right behind that? Like, think about that. Every bill that comes in the mail, why don't you have a check coming right behind that? So just think about that. You value credit score over net worth. This is another big one. There's people that have good credit and have access to capital, or they can have good credit and have access to capital, but they rather just have the ability to have access to capital and never use it. Or if they do use it, they use it all wrong. Instead of doing what the wealthy do, is they leverage their credit to get wealth and get and go buy income streams. So they don't have to worry about these different things. And you don't pay yourself first. So this is putting instead of a lot of times, many of us are in situations where we feel like we can't spare a single penny, and I completely understand that. And but that type of thinking, that type of like impoverished type thinking, the lack of thinking, scarcity thinking, that type of mindset, it doesn't allow us to plant the seeds to have a better future. So we just continue to live the same day, day in and day out, and nothing ever changes, and we just stay with this middle class curse. All right, so what are the publications are talking about? What is the media talking about? What are they saying? So nearly half of Americans need credit cards to cover essential living expenses. So we are living on borrowed money, meaning we don't have enough money coming in to keep up. Our raises is not keeping up with the cost of inflation and what it's going to take for us to live in this country. Americans lean more on credit cards as expenses stay high. So 46% of cardholders now carry a balance debt to debt, carry a debt from month to month. So again, this is Americans, nearly half of Americans are living or surviving from borrowed money because we just don't make enough money, period. Like no matter what level that you're on, we're just not making enough money. All right, so this here is credit card debt over the last couple of years, and as you see in 2020, um, from COVID, a lot of spending went down. So you'll see in 21, 22, and then as the world started to open back up, spending went back up, and not only did it exceed before COVID, but it is for much further along than it is. So credit card debt is continuing to increase. One, because again, we don't make enough money. We don't understand how to go get capital, how to go get more money. All right. So Wall Street Journal says Americans should be more financially literate. But what does that mean? That's actually a very good question because most people, especially in Black and brown communities, and particularly Black communities, like we have no real understanding or awareness about financial literacy, money, what to do. We spend $2 trillion a year, but we only account for 3% of the of net worth. Like 3%. 3%, we keep 3% of the net worth here. But we spend $2 trillion a year. But as a community, we have 3% net worth, right? So we in trouble. So we know about the class mobility myths. So go to school, get a good job, buy a house, and you'll be okay, right? You can easily change your life with a hard work and education. What are a lot of people that working extremely hard and extremely educated, and it ain't looking too good for them. And we all know that society is not fair. All right, so 72% of Americans said they are not financially secure. That's a big number. 26% of Americans say they'll never be financially secure. 61% of Americans say they live paycheck to paycheck. And this is outside of the 50% that make over $100,000 a year. So the other part of the country, 61% are admitting that they live paycheck to paycheck. 40% of Americans say insufficient retirement funds or emergency savings is the reason why is reason for their financial insecurity. So their ability to not be able to save money, hold money, keep money, or if something comes up, they don't have any financial backing to take care of that, makes them feel financially insecure. All right, so what do we believe money is for, right? So you can, if the shoe fit, wear it. So poor people believe that money is for paying bills and buying stuff, just being consumers, right? Just consume, 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 consume. The middle class or middle income people, they believe money is for financing or making payments on a lifestyle, right? A lifestyle that they can't afford, so they can look good on Instagram and TikTok. And then the rich use money to accumulate more money. And a side note about this is the rich don't use their own money. They use your money, to use the bank's money, to use private equity or credit. They use a lot of different other methods to to accumulate money, to obtain money, to acquire money, to raise money, and then they go out and they buy assets that spin off a lot of cash flow. And so that is how they stay where they are, and others don't ever make it to where they are. That is just our philosophy, our thinking about what we use money, like what the resource this tool is used for. All right, so financial freedom versus financial independence. So most people talk about having or wanting financial freedom. So financial freedom is having enough savings, investments, and cash on hand to afford the lifestyle you want for yourself and for your family. So you can have financial freedom and be slaving at a job that you hate, or you can have financial freedom and still be in poverty, because financial freedom is just having enough money or savings or investments or cash on hand to maintain a lifestyle. It's not saying a good lifestyle, it's just saying a lifestyle. So you could be making, $40,000 a year as a household, as a family, 50,000 dollars a year, which is struggling in most places. But as long as you're able to maintain your lifestyle and you're free from financial burden, you are financially free. But you are in a crippling situation financially, even though you're financially free. So financial independence, being enough to free one from the necessity of working for a living, not subject to control by others, is the status of having enough income or wealth sufficient to pay one's living expenses for the rest of one's life without having to be employed or dependent on others. Income earned without having to work a job is commonly referred to as passive income. So financially, financial independence is a whole nother definition and meaning from financial freedom, right? Being free from financial burden. Financial independence is the status of having enough income, wealth, uh, to pay one's living expenses for the rest of one's life without having to be employed or depend on others. You can pay for your lifestyle. You can cover your lifestyle for the rest of your life without being dependent on others. And oftentimes that is most often often happen through passive income. So class mobility stats here. 70% of the lower class never make it to the middle class. Class mobility is linked to our parents. So typically wherever our parents are when we're being raised, that's typically where they train us to be in the same position that they are in. Not many people actually move up, or even sometimes people who do move out of their parents' level or class level, they usually move down. Fewer people move up than move down. So typically our parents train us to be or follow their footsteps and be in the exact same position that they're in. Even though we may be doing it flashier or in a much flyer way or tasteful way. But at the end of the day, we're going to end up just like them, right? So less than 50% of millennials will ever earn more than their parents, right? And we know that to be true. Your parents' social inequality is passed down to you. So whatever you're born as, immigrant or black, white, Hispanic, Asian, whatever, Middle Eastern, whatever that you're born as, typically, um, whatever inequalities, whatever hurdles that your parents are facing, typically it's more than likely you're going to be facing those same type of hurdles, as you're trying to establish yourself and make money and try to move or try to have some type of class mobility. And this is another fact, it just costs too much to be poor. You pay the most for everything, which is crazy. All right, so what is active income? So active income, in short, is income that you're earning through work, through trading your time for dollars. Um, Examples of active income are salaries, tips, fees, commissions, and allowances from the companies you provide services to. So this is like we are trading our life for money, and that is active, and that is also the highest tax income by the government. So we trade our life for X amount of dollars per hour, and then the government hits us with the highest taxes in the land. So just think about that. That's why wealthy people they if they do have a high income skill, active income skill, they want to milk it as much as they can, and then until they get to a point where they can start marrying that money on with like raising capital or passive investments, and they want to spend that money into things that are going to be passive income, which will save them on taxes. Now, if you don't have an extremely high earning skill through active income, that's going to be very difficult for you, right? So, what is passive income? Passive income is money from activities where you have no active or direct involvement. So, again, you're not trading your life for X amount of dollars per hour, and then being taxed to death for doing that, right? So when you have passive income, you get to take the advantage of the most tax breaks, tax advantages, tax write-offs, that tax deferments, like all kind of different things. Like you pay the least in taxes on passive income. And this income, you can grow it much faster than you can with your active income because that is dependent on effort times time, right? So your work, your sweat equity times time, right? And then that equals whatever you're going to get out of that. So you only have so many hours in a day, you only can put so much work for in a day, and you only produce so much in a day, right? And so with that being said, it's your active income is limited, but passive income is unlimited. All right, so this kind of goes back to something I mentioned a little bit earlier in the training. And what I really want people to understand and uh, hold to is that understanding the value of becoming an accredited investor, or just at least positioning yourself as an accredited investor. So in the US, the term accredited investor is used by the Security and Exchange Commission, the SEC, under Regulation D to refer to investors who are financially sophisticated and have a reduced need for the protection provided by regulatory disclosure filings. So this basically means that you, one, earn enough money, you've accumulated enough assets, and you have enough financial literacy to be able to make sound investment decisions without someone overseeing everything that you do. Also, if you make a investment decision and you lose a little bit of money, or if that doesn't work out, or you lose your money, you earn enough money, you're in a position where it's not going to break, it's not going to be the end of the world for you. I've seen so many times where non-accredited investors, put their last $20 into an investment, and if that investment doesn't make them $10,000 by next week, they want their money back. They want the $20 back. And the reason they want their $20 back is because they needed to pay their rent next month or this month. So when you're not in a position as an accredited investor, you've established yourself well enough where you can have, you understand that you know you need cash flow coming in, you have assets, passive income, you have things set up where if something happens, you lose 10,000, 20, 50,000, even $100,000 in an investment, it's not the end of the world for you. You're not going to go broke. You're not going to go homeless. All right. So qualifications as an individual to become an accredited investor is so the last 2 years of earnings exceeds $200,000 and is expected to continue that in the next year. So again, that's last 2 years you exceeded $200,000 in earnings and you're expected to do that again the next year. And as a couple, as a household, it's 300 grand, and or you have $1 million in net worth, and this excludes your home. And you have like some type of education, training, or certificate, like a financial planner or a financial advisor. In this instance, you don't have to meet the income requirements because you've taken training or classes and you understand investing, right? All right. So for an entity. So if you want an entity to act or be an accredited investor, that entity has to have assets, exceeding $5 million, or one of the board members or equity owners in the company. Um, if they are also as individuals accredited investors, then they are sophisticated enough for this entity to operate and function as an accredited investor. Okay, so why is it important to position yourself as an accredited investor? So these are some points that I came up with here. Is one is you need to bring in more money every year. So you can position yourself where you can jump into investments and make decisions and be able to bring in more capital, more money, whether it be active income or passive income. You need access to more money. So being an accredited investor, you're able to get in on funds, get in on private investment opportunities. You're able to raise money, being an accredited investor to go into other investment opportunities. You can be as also being an accredited investor, you're going to have friends that also are high productive and high earners and also are accredited investors. And you can overhear a conversation about maybe one of the buddies, he may be going through something. He has a real estate portfolio that he needs to liquidate and it has a bunch of equity in it. Well, if you're not an accredited investor, you can't get on those type of deals because you don't qualify to get those type of deals. But just being in a position as an accredited investor, you can say, you know what, hey, I got some money I want to put in with that. Let's do this. Um, you need assets that pay you, but not just pay you now, but pay you for generations. You need access to private and exclusive investment opportunities. I just talked about that. You need to save yourself and your family from financial ruins. So again, position yourself where you're bringing enough money in, you are acquiring assets. So if the economy goes down, the economy crashes, inflation shoots up, this one stock or something like that goes down or whatever happens, you are stable because you got assets, you got cash flow coming in every single month, week, or however, quarterly. You have cash flow coming, you have assets you can tap into, you have income coming in that is sufficient to take care of you and your lifestyle. All right, so now we're going to get into the fun stuff. This is going to be funding secrets. All right, so some funding secrets is when you're going to go get funding or business credit for a new business, a new company, a startup, someone that, and new, it means less than 2 years. So you're under 2 years. They are going to want to see some certain things. They take you through a process when you go apply for some type of business funding or business credit. One, they are going to look at your personal credit. So they're going to want to see that you have a strong personal credit score. Excuse me. They're also going to check on your business credit, whether you established it or not. So they look at FICO, they look at the uh, SBSS, they look at Duns and Bradstreet, they look at the SBEF, the Small Business Financial Exchange, Credit Safe, and other business credit reporting agencies. because they're going to have data and information on you. And another tip here, another secret here is that you want to make sure that your business information is congruent, like exactly the same across all these different um, data or business credit report agencies with the Secretary of State, right? You want to make sure that all that information is the same because if it isn't, you could be denied. Another thing they check, they're going to check LexisNexis. They're going to check OFAC. They're going to check the Social Security Administration to verify your identity. These things that these OFACs and stuff like that, they started doing this after the terrorist attacks, and Obama like put this in place, and just to because people can use entities to do different types of to fund terrorist operations or racketeering or different type of crimes and things like that. So they want to make sure that these entities are well documented, and they can find someone when it's time to, when they're looking these places, when they're looking this stuff up, right? So you want to have your operating agreement in place. That's something that they may ask for. They want the two most recent personal and business tax returns. They want to see what you're looking at as far as your income. What is your business making money? Are you making money? Another thing they check is another data report agency is called TaxGuard. So this is when you submit tax documents or federal documents. They can't go to the IRS and verify this stuff. So there's another data report agency called TaxGuard that verifies IRS filings and also gives your IRS filings and your income a risk code to the lenders. So that's something else you guys should know about. And then if you need any type of licensing or business liability insurance, they're also going to look at your bank statements for the business, any of the business accounts, and also like merchant accounts as well for the business. All right, so no doc funders. This is the funding that I'm going to be mostly training on or talking about throughout this training is no doc business funding. This is some of the easier money to get, the lower barrier to entry. So one thing they're going to be looking for is they're going to look at your purchase power. Like, what is your consumer credit report looking like? Mainly, they're going to be looking at is your credit cards, and your history there, your credit score. How are your personal finances with or relationships with banks going? Another thing you're going to do is you're going to need to create a legal entity, a legal person, and then you can fund that entity. And then after you go fund that entity and you're, you know, investing in what you need to invest in, also look back into reinvesting into some age corporations, which will be a special purpose entity. And this could be either a shelf corporation or a shell corporation. A shelf corporation is typically a entity that was set up and it was just placed in a file cabinet, waiting for years down the line, 2, 3, 4, 5 years down the line for someone to come along and need that shelf corporation to do what they need to do for their business. So let's say you have a business that became very successful. You started an LLC. It's a year and a half. You're making good money, and you're looking to go raise more capital. But uh, most oftentimes, to get the real good money, they don't want to see LLCs. They want to see C corps. So what you can do is you can go purchase an older C corp, and because they're going to say, no, your business is too young, we're not going to fund you this, X amount of dollars, is 7 million or whatever that you need to start this franchise or do whatever you need to do or do expansion or do whatever, right? They're gonna want to see that your business is a little older. It's just part of their criteria, even though that your business is doing well. So what you can do is you can go purchase a shelf corp or age corporation and put that LLC under that age corporation. And so now you're suitable and you're able to go back to the bank and now you're able to get that money that you needed. And a shell corporation is pretty much just that. It's just a shell. It pretty much it doesn't have a lot of functioning to it. It's not something that you create to go into business with. So, for example, if you buy real estate and you do the smart thing and you put your real estate into LLCs, those could be considered shell corporations. Sometimes shell corporations could be corporations that are set up to help with taxes. Sometimes they just hold things. It can be a holding company. Again, so these are entities set up that are not in the day-to-day function of doing business and earning income. They are set up for a very specific and special purpose, and it's typically not to do business, but to carry out different type of business functions. All right, and then you can give that entity credit. We're not going to go too far into that in this training because I'm going to give you a whole lot in this training, but this is something that you should be aware of. So once you buy that age corporation, that shelf corporation, you can actually give it credit and go to the bank and get funded. And you could go fund that age corporation, and you can keep going back and rebuying more and refunding and funding and funding these corporations until you have seven, eight figures. You know, this is something that's very commonly done in business, especially when looking to raise capital in a short period of time. All right, so a special purpose entity is a legal entity created to fulfill narrow, specific, or temporary objectives, right? So typically, these special purpose entities are typically used by companies to isolate the firm from financial risk. So again, so let's say your employee went out and did something, and because he's an employee of your company, you can be that your company can be sued or the company could be sued. Well, that company has assets. What they'll do is they'll go set up or go buy some shell corporations and move those assets and those accounts and all that money into shell corporations to hold that and to protect it from being sued, right? Obviously, if it's something criminal, your assets and things will be frozen and you'll be harder to do something like that. But if it's something that's not criminal, if it's legal or something like this, like a litigation, you can move assets and different things into shell corporations. Again, they're not designed to go uh, provide services and products to people. They're for a very specific type of person, reason. All right. So also they can be used to hold assets, to transfer assets from one person to another, from another company to another, from parents to children. They can a trust is a special purpose entity. So there's a lot of different types of special purpose entities out there, right? So and these are considered like shell corporations. All right. So all right. The good thing about consumer credit is that, man, you literally can build the credit profiles to meet the bank's underwriting criteria. And this is something I learned back in 2014 when I first started doing this, when I worked for a consulting company that raised capital. They showed me how to set up credit profiles and remove information, add information, and make it meet the lending criteria of these banks so we can able to get them funded. So typically what these lenders are going to be looking for with this particular type of funding, this type of business funding, they're going to want to see that you have a pretty good credit score. Typically, 740 and above is going to be really good. And this is going to be FICO scoring model 8, 9, and sometimes even 10, but mostly 8 and 9. If you have less than that, like a seven, at least over a 700, typically, you can get funded, but it's not going to be as much as we got like a 750, 770, or something higher like that. But you can still get funded as long as you got like over a 700 credit score. So you have 10 plus accounts that are open and active. You have low utilization. Now, to most people, are going to be hear that, utilization under 30% is what is required to keep your credit score from dropping. Yes, that is for the FICO algorithm, but as far as for the lending algorithm, we want to keep our utilization under 10%. Excuse me. Typically between like 2 and 9% is like the sweet spot that we see when we want to go for funding. We've seen that if your utilization is at zero, yeah, you can still go for funding, but they see that as you're not using your credit, and they don't really want to give you more credit because they don't feel like they're going to make money off of you, right? So obviously, we want to have no derogatory remarks, bankruptcy, charge off, collections, late fees, anything like that. We don't have none of that. We want to have primary accounts. So revolving accounts is the most important accounts on our credit reports, like bar none. To get the best outcome for this type of funding, if we have credit cards that are 10 grand or more as far as our credit limits, we can get away with, 5 grand minimum, but the higher the better. And then you want to have relationships with national banks and also regional banks. These are going to position us the best to get this type of business funding. All right, so we have different types of money that we can get for our business, or capital that we can, or credit that we can get for our business. And a lot of times on Instagram, YouTube, TikTok, or whatever, people kind of mush these things together, and it's like kind of misleading. Well, it is misleading information. So business funding is not the same as business credit, and business credit is not the same as corporate credit. And just in general, to kind of break this down for us and make it simple for it. So business funding is mostly relied upon the FICO scoring model. When you're going to get business credit, that's going to be the paydex scoring model, like Duns and Bradstreet, the business credit report agencies. They're going to be looking at those um, agencies as far as should they lend you credit. And business credit typically, and most oftentimes, it starts out as business to business trade or transaction. A business is giving your business a trade line. It's not funds or cash or credit cards. These are going to be net 30s, it's going to be fuel cards, things of that nature. You build those accounts up to get to more like loans and things like that, for your business. And then corporate credit is going to be like based upon the business financials. They're not looking at the officers of the company. They're not looking at their FICO scores or their personal credit scores. They don't care. They're not looking at, if you got an 80 or 90 or 100 paydex score. They don't care. When you're going for corporate credit, they're looking to see, is this business sustainable? Is it bringing in? Does it have good financials? Does it have good leadership? Does it have good management? Does it have good systems? Does it have a good customer base, that's going to continue to purchase from, like, they want to see the stability of the income. Um, what assets does it have? What liabilities does this company have when you're going to acquire corporate credit? And this is when they don't look at your, again, they don't look at your personal credit at all. And again, like a lot of so-called gurus out there, they say, oh, you can get business credit, no PG. They're not going to look at your personal credit, blah, 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 blah. Right? I was like, well, that sounds like corporate credit, not business credit. Because even with business credit, even though you're not PG in it, personal guarantee in it, they still gonna want to look at your personal. They have to look. They have to look at your social security number again. They got to check to see, one, that you're a real person, that you're not you are a U.S. citizen, and that you are legit. So they are going to take a look at you, to even consider you for business credit, in most cases, in a lot of cases. All right. So it's more funding secrets. All right. So we want to make sure that, as far as with our entity, we want to have no personal phone numbers, no personal cell phones. We don't want to go get a second cell phone and have that as our business number and put that on our business cards and on our business entity, organizational paperwork and websites and things like that. We're not doing that. No home addresses. Even if you do work at home, you want to go get a virtual address. For this type of funding, home addresses do not work well. Can you get funding with a home address? Yes, you can, but you're not going to get as much as if you had an actual business address. All right, aged websites. So aged websites, this is going to be, they're going to count. They have a system that when they look at your website, it counts how many hits or visits your website has had, so that you're not looking like, they check to see, like, for fraudulent activity. Did you just open this website and nobody's ever visited it, right? Or you just pay somebody for this website or something like that? You just popped it up today and now you're looking to get money from us. Has anyone actually visited this website? So to get around that, basically you can send your website out to, a mass text or email list or something like that, friends and family, and just ask, hey, check out my website, just open, just got this website, tell me what you think about it. And they're gonna want to go click on it, and then you're going to get those hits, and then that's going to help with getting over that hurdle. Business email address. So you want your business email to have either your name at businessname.com or info at businessname.com. You don't know Yahoo, Gmail, Hotmails, anything like that. You will get denied. Get your free NIN number. Have your articles of incorporation ready, and make sure all that stuff is set and everything on there is correct. We want to make sure that we're opening a business bank account. So they're gonna look to see if you have one of those as well. And then we want to pick some low risk SIC and NAICS codes. I'll get more into that. You want to pick your own codes and not have bankers or lenders try to pick one for you. And then also you want to make sure that you have social media presence. So you create a Facebook business page, you create, LinkedIn pages, you create TikTok page or Instagram page. They do check these things. Also, get with Yelp, get with 411, and also get listed with Google as well. Because if they can't Google your business, they can't go on business directory to find your phone number. If you're not findable, you're not fundable. So all of this is helping us to be findable so we can be fundable. All right. So when we're going for this type of business funding, some of the things that people do, they think that they can go when we say, oh, we can get you $100,000 in business funding. They believe that they can go get that 100 grand with one product on the first try. And so there is a threshold that banks have when you're getting new products or certain, at least no doc products, lines of credit or credit cards or loans, and it's all stated income and just stated everything. If you apply for anything on the application more than 50 grand, it's going to automatically trigger a review and they're going to require documentation. So that threshold is 50K if you're doing it by yourself. If you're working with a bank representative, I'll get more to that later, but you can go a little bit higher than that. Well, they can bump it up higher than that. So that's a good part about having that relationship. So okay, some banks and products have income minimums and maximums. So on your personal income, and also on your business income, if you put too much income on the personal side, on the business side, it will cause a review of your application and sometimes a denial. And if you put too little, it's just going to be a denial. It also can cause a review as well, but oftentimes it'll just be a denial. So there is sweet spots in between where the income that we want to put on the applications, and as far as for personal and for business. During our one-on-one consultation, if you decide to hire me as a coach, I'll let you know exactly what those metrics are. But just know that there are specific metrics that trigger these reviews and denials. And most people don't know that. They think that, oh, I'm gonna make all this money, I'm gonna put all this number, that number, and it's not the same for every single bank and every single product. Each bank and each product has different metrics, different for the algorithm. And if you don't have those numbers, again, if we decide to work together, as hire me as your coach and helping you through this process, I have those metrics. All right. So if you go to get an age corporation, or if you have an age corporation, if you go buy one, if you go buy an age corporation, or if you um, learn how to get your own age corporation, you're not going to run down to Bank of America, Wells Fargo, or Chase and apply for traditional type of products. You have to go through other type of lenders, other type of banks first before you go to them. And I'll get more to that at another time. But don't do that because you're just going to go get denied, because they have systems that, especially if you didn't do it right, or if you bought it for somebody who didn't set it up right, or didn't if your age corporation is not, it doesn't check all the boxes, because the banks have systems, back end systems that run scans on all kind of different things about your corporation. And if they find any type of discrepancies in there, change in filing names, ownerships, things like that, they can see that as like fraud or red flag, and then deny you, right? And plus, you have no credit history or any type of experience working with any type of bank, so they can deny you. So when you're getting age corporations, there is a certain type of funding that you'll be going after. All right. So that's another secret there. All right. So yeah, also yeah, so in the best age corporations, they're gonna come with tax filings, they're gonna come with trade lines, credit, things like that already built up. Some of the best ones they are sold by attorneys and law firms. So that's another way that they make money, especially if they have like apprentice or paralegals. They give them work as far as like setting up age corporations and putting those on the shelf because they know that they can use those for funding for litigation and to make money outside of their law practice. So oftentimes paralegals and apprentices they will set up uh, corporations for law firms, and then they sell them. But you can get it from other places other than law firms as well. But that's just a little tip for you guys. Okay, and then the best formation or entity to get that's going to raise the most capital and be able to raise the most types of capital and products will be C corporations. They get the best. They get the best. You can raise a lot of money with LLCs, S corps, things of that nature. I don't deal with sole proprietorships, but the C corps, they are the father corps, and they get the best. They get the most, and they get the best. Okay, and then you want to apply to banks that are friendly to your SIC and NASI. So based upon what your business does, and that's what this SIC and NAICS codes do. They tell the banks exactly what your business do. So oftentimes we can go to a bank and get denied because we're going to a bank that doesn't understand our business, understand our industry, and they don't feel comfortable lending to someone in that particular industry. Then you got other banks that know that industry well, understand the industry, and will lend to that industry all day long. But if we don't take into account, understand, okay, who are we applying to? We can get denied and then think that we're unable to get funded. All right, so now we're going to get into some facts about credit. So credit, the word credit actually comes from a Latin term. And forgive me, anybody who speaks Latin, Italian, or anything like that. But credere, and it just simply means to believe. It's just belief. Belief that it is what it is and that it exists and that's what it is. It's just belief. That's what credit is, and that's what money is. It's just whatever you believe. It's if you believe in it, you believe it's real, you believe it's there, you believe it has value, then it does. It's just belief, right? So to keep it simple, credit is credibility and trust. How do you get banks to trust you? What we do is we leverage the consumer reporting agencies. That's something that I have learned how to do over the years is leveraging the consumer report agencies. So one, credit is just information, is data as far as like our credit profiles, our credit scores, our credit consumer credit files, whatever you want to call it, is just information. And we could uh for lack of better terms, manufacture the information that we want the lenders to have, right? And then we feed that to the credit report agencies, and then the banks go grab it from the credit report agencies. They see that it's the information that they like, and then they give us the money, right? So again, we curate the information and make sure we have the right information on our credit reports, the best information on our credit reports, the right type of accounts, the right scores, the right relationships on our credit report. We're taking off information that we don't want on there, too many names, addresses, derogatory things, subprime credit cards and accounts, taking that stuff off of there and leaving the good stuff, and then we're putting more good stuff on there, right? So we can make our credit reports look however we want them to look. We have the legal right to do that, and the federal government gives us and backs us on that efforts. But yeah, we feed that information to the credit report agencies, and then they feed it to the banks, and then the banks feed us money. And that's how the cycle works, right? So we feed the credit report agency information, they feed the information to the bank feeds us money. And that's how it goes. That's how funding works. All right, so FICO stands for the Fair Isaac Corporation. And so this is what FICO was a pioneer in developing a method for calculating credit scores based on information collected by consumer report agencies. FICO creates scoring models or algorithms. So information that we feed to the credit report agencies, they run that information through FICO's different scoring models, and it produces risk scores, right? And these are our credit scores. And then again, they feed then the banks buy that information, buy that credit score from FICO, and then the credit report agencies feed the information to the banks, and then banks feed us capital, feed us funding, feed us money, right? So that's how that works. All right, so and there's a lot of different FICO scoring models that most people don't even know about, but there's a lot of them. So these are some of them here. We have so for auto loans, credit cards, mortgages, there's different each credit report agencies use a different models to score you. So that's why you can look at your credit reports across different credit report agencies and see different scores. Um, different and oftentimes when we're looking at our credit scores like online, most oftentimes we're looking at FICO scoring 8 or FICO scoring 9. We keep looking at different. If you go on Experian.com or FICO.com, you can see all your different FICO scores and the different algorithms. And then we have the newest FICO scoring model from FICO, which is scoring model 10, and also scoring model 10T, which is trailing 12. So now um, banks or the FICO system, they're not just looking at the snapshot of what you look like today. They want to see what you look like for the last 12 months. You know, did you just whip up something really quick? Because this is really came from a lot of people abusing um, credit building opportunities, credit building resources, trade lines, things of that nature. You know, they're just creating all this synthetic credit fraud and then trying to go to the banks to get funded. So they're going to want to see over the last 12 months, have you been maintaining this type of credit for a period of time, or did you just whip something up? All right. So that is FICO scoring model 10T. All right. So many of us have seen this diagram on the right here. So what makes up our credit scoring and our credit report is going to be 35% on your payment history, 30% on utilization, 10% on your credit mix, 10% on unseasoned and new credit inquiries. And unseasoned means the account is less than 4 billing cycles. So when it crosses that fourth billing cycle, some on the bank side, sometimes it's 6 billing cycles, but once it crosses those 4 billing cycles, which is why they say, okay, if you open a new account, your credit score drops, and then after a couple of months, it regains back. That's because it's no longer considered a new account. It's seasoned after four billing cycles. So, and also if you have a bunch of inquiries on your credit report, that also factors into that 10% as well. And then also the average age is 15% of your credit report, average age of your credit report. So people always asking like, how do I get this credit score? How do I get 100? How do I get this? How do I get that? Right. So when we break it down here on the left, we see that the scoring model, FICO scoring models goes from 300 to 850, which leaves us 550 points to work with to get to these perfect credit scores, right? And in each of these categories, there's a certain number of points that you can maximize to strengthen those categories to get your score up to where you want it to be. So you can now you can take this and look at your credit report and your credit score and be able to see, okay, I'm weak here, weak here. Let me go ahead and get more points in these areas, which is going to boost my score. But most people think, oh, if I just pay my bills on time, then my score is going to go up. When we get strategic and we understand and know what we're doing, we can make our scores shoot uh 20, 30, 40, even 100 points in 30 days, right? Because we know what information is needed and in certain categories on our credit report to make it jump up and meet those criteria they want and get these scores they want. So for new credit, it's going to be 55 points. For credit age, that's going to be 82.5 points. For your credit mix, 55 points. For credit utilization, that's 160 points. So if your credit utilization is high, you're going to be dropping in these points significantly, which drops your credit score. If you have late payments in your payment history, that you're going to be dropping, from 192.5 points. So these areas here, once we get rid of like our late payment history and derogatory information, we gain back all those 192.5 points. When we get our utilization under 30%, we get back up to this 100. If we get up and down to zero, we get up to this 160 points. But if we get below 30, we can gain many of these points back, which gets us up in those high 700s or 800s of where we want to be. And this is how you get these credit scores, is understanding where your credit report is weak at, and then how to go get the information to feed to the credit report agencies so they can, when it runs through FICO scoring models, that you can get those high scores. All right. So if you're not aware of these, there are some websites and online like communities called FICO forums. And basically, these are people that collect information and share information back and forth about their experiences with credit cards, loans, banks, you name it. And so basically, you go on here and you can ask questions, you can talk with people, you can share your experiences as far as like, what your experiences was with a certain bank or lender or a certain product, what your credit score was. And you can kind of see like what's going on and kind of feel your way around when you're looking to learn a little bit more about like funding metrics and things of that nature. A lot of gurus go onto these websites when they want to make TikTok videos or YouTube videos and things of that nature. They go on here and they get information and they find out what's new, what's the new credit card, what's the new trend, what's the new product coming out, what's the new credit builder, what's changing or whatever. They go on these credit forums, these FICO forums, and this is where they get information. Then they go make YouTube videos about it to look like experts. But anybody can go onto these forums and and look around and learn. All right, so now let's get into structuring our credit. All right, so many of us suffer from a thin credit file. And a thin credit file is when we have 1 to 4 accounts or trade lines on our credit report. And a lot of us have thin credit, and we don't even know that we have thin credit. We have 1 or 2 credit cards, one auto loan, and maybe one other thing on there, right? And we don't want no more credit, right? We just want to maintain these couple little pieces of credit. Well, you are a high risk borrower, and anytime you have a thin credit profile and you get any type of derogatory marks, you use your credit card, you do anything with your credit, it's going to be your score is going to be shooting up and tanking down, shooting up and tanking down because it's not enough credit or data or information on that credit report to keep it stable. So if something happens, you do something, you do one thing, you buy something, your credit score tanks, and then when you pay it off, it shoots back up. So your credit score should not be that volatile. You should have a stable credit score. If you make payments, things like that, your credit score should be rising gradually. If you have some type of collection pop onto your credit report, you shouldn't be losing 200 points, or something like that. If you have a stable and a strong credit report, if you get a collection that pops on it can probably just drop you 30 points, 30 or 40 points. And if you're already at a 750, you're still in the 700s, right? So that's the difference. But if you have a thin credit report and you have like a 700 credit score and you get a collection or a late payment or high utilization reports out, that's going to drop your 700 into the 600s, or into the 500s. So having a thin credit report is dangerous. We don't want thin credit reports. We want well built out credit reports. So this is an example of what we would consider like a built credit report or like a thick credit file. So we're looking at all the points here. We have 100% payment history. We have little to no credit utilization, so we're getting all the points there. No derogatory marks, we're getting all our points there. We have 7 years of age. So this is another important um, data point when it comes down to qualifying for lending is we want to be over 5 years of average age. We can get away with 4 years, but 7 years or more is really 10 years of average credit age is really where you want to be at. Even if you have like a 600 credit score and you have a high average age in your credit report, it shows that you're stable and you've been managing credit for a longer period of time. And you can get approved for more products and a higher products than someone who has a lower credit age and a higher credit score. So that is something that I've seen myself. I was kind of shocked when I actually the first time I seen someone get approved back to back, back to back, back to back for loans and credit lines with a six. I think they had like a 630 credit score, but they had high age, and they had a bankruptcy that was a couple years old on their credit report. But they were getting approved because they had good age on their credit report. And this person has 23 accounts on their credit report, which is amazing. That's great. And then no hard inquiry. So they're getting all their points there. They have good credit mix, good credit age, no derogatories, low utilization, 100% payment history, and no inquiries, no derogatories. That's great. All right. So this here is it's out the way. All right. So this here kind of goes through how we want to set up and structure our credit report, our consumer credit reports. So again, a 740 plus credit score is more ideal. Again, you can get away with a 17, 720. 10 to 15 accounts open, reporting out of, and this doesn't necessarily include student loans, but if you have student loans, that helps. But let's say this does not include student loans, and let's say you have 10 accounts on your credit report. Majority of those accounts need to be credit cards. Like credit cards are the most important trade lines on your credit report. Those are just the most. One is they're perpetual, they're forever. They give the banks and lenders the most about your spending history, um, data information about you. A credit card will tell you if you're in financial trouble faster than a auto loan or a personal loan would. A credit card tracks your day-to-day activities and habits and spending. So credit cards, they give a lot of information. Again, they're perpetual. They hold and carry the age of your credit report. Loans, when you pay them off and those accounts close, then you no longer have that age anymore. You have credit mix, but you don't have that age anymore. So as you're closing accounts, it drops your credit age, drops your credit score. But if you have a number of credit cards that you've held open for a number of years, those are going to be the foundation to keep that credit age up, even if you go and pay off your car loan or mortgage or something like that, right? All right. So minimum credit cards, the minimum we for the credit limits is going to be 5K, but ideally we want like 10K or more. But 5K we can still do some damage with. We can still get funding with that. Less than three inquiries, especially in the last 6 months. If you have a paid off installment loan, especially if it's 10K or more, that helps a lot as far as your points and your credit mix. No derogatory indicators, and which can be misspelling of names, wrong names, variation of different names, a bunch of addresses, a bunch of jobs, a bunch of phone numbers, a bunch of email addresses. A lot of those are all like red flags to banks. It shows that you're unstable and that you're using all kind of different information, so that you could be fraudulent. So you're high that can be considered a high risk. And then 7 years of average age, minimum of five. works as well. Again, some people get away with 4. You can still go through the process with 4 years of average age. You can still get some money. You're not going to get as much if you have more than 5 years or more, 7 years or more. And then our credit utilization, we want to keep it between 2 and 9%. This is data points that we got from feedback from the banks. This is what the employees are telling us, and also what the approvals are when we're going after the approvals, what the approvals are telling us. So people that are in this particular range, they are getting higher approvals than someone who's at 0%. And again, every bank and every lender is not the same. All right. So when we are putting our credits together, when we're structuring our credit, when we are building our credit, establishing credit, um, we want to stop going after subprime credit cards. And one thing that I hate the most is looking at a credit report and seeing these subprime cards and accounts on your credit report because it makes it so much more difficult for you to build credit, to not get ripped off, and to go get funding, because these subprime cards, they have data points on your credit report that lenders don't want to see. They don't want to see that you're doing business with subprime banks. They don't want to see these low limit credit cards, 300, 400, 500, $700. Like that's and these type of like if you're a subprime lender ideal customer, then you're not a prime bank or a major bank or prime product ideal customer, right? Another subprime credit card is Capital One. They do have like their travel cards, and a Quicksilver card that you can go after funding for, and be strategic with. Don't ever go after their business credit cards or that platinum card or any other trash they got. There's way more better options for you out there to build credit and to get credit established than going to Capital One, especially these particular First Progress and this Credit One and First Premier and Maverick Bank. Maverick Bank is why I can't stand none of these damn banks. Oh my God, it just make a credit report look so terrible. So terrible. All right. So an alternative to building up our credit instead of going after these subprime accounts, if we got thin credit profile, is we want to go after, and I'm not a fan of secured credit cards, but we can leverage secured credit cards in a certain way to build our credit, excuse me, and position ourselves for funding. So most secured credit cards, they just work as you deposit your money, and then whatever um, money that you deposited into that lender, to that bank, they extend that to you as credit. So typically on a non-secured credit card, the bank will create a brand new credit line, brand new money, and then extend that to you as credit. So in this case, you are the one, instead of them creating brand new money, they're just using your money as security, then extend it to you as credit. So the type of secure credit cards that I like are the credit cards that you can use when you have like some savings put away. So if you have saved up 5, 10, 15, 20 grand or something like that, or you have access to that type of money, you can go get a secure credit card, put the 5 grand onto the secure credit card with a secure credit card that graduates, which means that they only hold your deposit for a certain period of time, and then they give it back to you, and it then becomes a unsecured credit card, and then they increase your credit limit. Typically, that happens with about six to 18 months, depending on what card that you get. This is an example here. This is from Navy Federal. Navy Federal is not the only uh, lender or financial institution that offers these type of products or this particular type of product. But again, if you go get a secured credit card with $200, it's not going to do anything for your credit, and it's going to work the opposite of when you're trying to go get funding. So you can take the 5 grand that you're saving, you're not going to spend it anyway, and you can leverage cash to build to have put trade lines, primary trade lines onto your credit report. So with this particular card, you can put your 5 grand down, After 3 months, they will increase your limit from 5 grand, maybe a couple $1,000, sometimes more. They can even double it. And then after 6 months, they will give you back your 5,000, and then it could be completely unsecured. So in 6 months, instead of having a $200 secured credit card for 6 months, now you can have a $10,000 unsecured trade line on your credit report that you can leverage to go get business funding with. But you can't do that with a 200, 300, $400 secured credit card that doesn't graduate, right? All right, so these are the list of credit cards that are secured cards that do graduate. You have the Discover It secured. You have the U.S. Bank Altitude Go Visa secured. You have the U.S. Bank Cash Visa secured. The Bank of America Unlimited Cash Rewards secured card. Capital One Platinum secured card, and the Capital One Quicksilver secured card. Now, with the Capital One Platinum secured card, you have to double check and make sure that um, the card is going to graduate. Sometimes with Capital One, they will do it automatically. Sometimes you got to request it. It's never like a straightforward thing with them. And this another reason why I just don't like Capital One. But this the Quicksilver one would be a better product to have on your credit report to have that unsecure into a Quicksilver product. So just be aware of that. So if you're going to use the if you're going to, and there's so many other banks and options and credit unions out there. You don't have to go with these, but just some of the major ones that are not like geographically locked or anything like that. Anybody from anywhere can apply for these and get these cards. All right. We also have secured loans. Sometimes they are referred to as like CD loans, certificate of deposit loans. They work very similar to the to secure credit card, but with these, you can actually put these loans onto your credit report at a much. So when we go back to the other slide where it said like a 10K person like a personal loan or consumer loan, you can actually use your again using savings, using cash or your access to cash to put into a secure loan, 10 grand or whatever. Some people, they go after the Navy Federal Pledge loan, they put 100 grand in there. Navy Federal reports out 100 grand loan. But before it reports out, they pay off 90% of the loan. So now it's reporting $100,000 loan paid off at 90%, and then they just pay off the other 10% over the next couple of months, and then Navy Federal gives them their money back. So now on their credit, it shows that they took out a loan for $100,000, paid it off, and now they can qualify to go get, a bigger mortgage, or they can qualify to go get, a bigger home equity line of credit or a credit line or um, a more expensive car if they want to go get exotics and things of that nature. That's something that a lot of these guys do. Is what they federal pledge loan. They get these trade lines on there, and they'll do a couple of them. So they may do two or three loans at $100,000 or 90,000, $50,000. Stack them up on there to build out their credit report, to give the impression again that they are borrowing these. They're getting approved for these loans or getting these loans, and they're actually paying them off. All right, so these are some websites you can go to, some lenders that you can go to get secured loans or these they call them different, they have different names for them, but they're like credit builder accounts, credit builder loans. So you got a bunch of different banks that you can go just pay into them. Some of them you put deposits up, some you just sign up for the program, you just pay a um monthly payment and then it reports out that loan or whatever. So there's different types of products out there that you can get, but they all pretty much report and work out the same way. And also these some of them report out as like a revolving, like a line of credit versus like an installment loan. So that's something else that you can look into as well. So you got Money Lion, um, Lockbox is another one that I've used. Covo Credit, you can check into that one. Kickoff, Navy Federal, obviously, Self Lender or Self Inc. DCU, that's a credit union. Yes, but it's a bunch of them on there that you can check into. You go to these websites, look at their credit builder accounts, and start building up your credit profile, getting it ready for funding. All right. All right. Another thing that you can do is you can ask friends and family for help to build up your credit, and you can go get an authorized users. So some people think that authorized users is illegal or something like that, but I wanted to show you from the largest consumer report agency in the world, but especially in America, Experian is suggesting that you can use an authorized user to build up your credit report, to fill in those gaps for data points. You can also do what's called like a joint account. Not a lot of people know this, but let's say you have a friend, family, spouse, or whatever. They've had a credit card for a number of years or whatever. Instead of adding you on as an authorized user, which will reflect that trade line onto your credit as a like a secondary authorized user account, you'll still get a boost in credit, but lenders know that that's not your account that you open up and that you manage. But if you are added to that account as a joint owner of the account, then that account reports to your credit report as a primary trade line. Now, the only thing about that is that it doesn't reverse. So you can't, once you add someone as a joint, it doesn't reverse. You cannot remove that person off that trade line or from that account. As an authorized user, you can do that. You have a lot of control over that person, how long they stay on there, and what they can do with that trade line. And it also say act as a co-signer, but we know that we don't do that. We don't do co-signing. We don't co-sign for other people. 99% of the time you will be screwed. All right. Another way we can get our credit report in order or together and ready for funding is we can go get limit increases on the cars that we do already have. We can go ask for limit increases, or we could there's a certain activities that you can do to get limit increases. So banks usually do this with like in 93 statement periods or 90-day cycles. If you are charging your card and paying it off, charging it, paying it off, charging it, paying it off, charging it, paying it off over a 90-day period. And when I say charging, it doesn't mean throughout that bill cycle, run the card up to the limit, and then when the bill is due, pay it down. That means every week or sometimes multiple times a week, you're going to be putting, living expenses, different things onto that card that you spend cash on every single month anyway, charging that thing up and then paying it off. You charge up for a couple of days and pay it off at the end of the week. Charge up, pay it off, charge up, pay it off, charge up. What is showing is that to the lender is that the limit that they've given you is it's not enough. So that they may have given you a $3,000 or $4,000 limit, but in a bill cycle you're spending $5,000 or $6,000, right? So you're paying again, charging, paying, charging, paying, charging, paying. So what they'll do is it'll trigger a review for you. They will do a soft pull on your credit, or they will look at their own internal data metrics and scoring models and determine like what they want your credit limit to do. And the more you have this activity, the more you can get automatic increases on your credit card. If you manually go in online and request it or call in to have a increase, typically you only can do that maybe two, maybe three times a year because they usually have waiting periods as far as how you can request limit increases. Another thing is you can refinance your auto loan. So if you have an open auto loan right now, you can go to another lender, get a loan to pay off that loan, and then open a new trade line. So it'll pay off the old trade line and then open a new trade line. So then you'll have another trade line on your credit report. We don't want to get a refinance loan. So if we're going to go to the same bank or same lender, we want to make sure we're opening a brand new loan that is going to pay off the old loan and open a new trade line onto your credit report. We don't want to have the bank restructure the same loan as a refinance, because on your credit report it's going to say refinance and not like you're being approved for a brand new loan or a brand new product. And then it's going to be just the same, it's going to count as just the same trade line, right? They're just restructuring the trade line you already that loan you already had. So we don't want it to say refinance. We want it to say paid off, paid in good, closed, and a new account that you've been approved for that's opened up. So and you can do that a couple times throughout your auto loan, the history of the other auto loan, or your length of having that car. So you can use that car to build up loans and build up that credit report. And then you also have unsecured loans. So we talked about that. Getting an unsecured loan, paying it down, the majority of it down. Also with our auto loans and even personal loans, simple interest loans, the way that we can avoid paying interest on these loans is that let's say your car note is $400 a month, right? And your interest rate is 11%, which is high as heck, right? You're paying a lot of money in interest per month. But if you divide that $400 into four, and you pay $100 every week, what's going to happen is you'll still make your monthly payment the way you're supposed to be making it for that month. You're paying your $400, but you're eliminating all that interest accruing over that 30-day period, because that every week you're paying to the principal of the loan and not to the interest of the loan. So you're knocking down the principal, and which is cutting out a lot of that, cut a lot of fat out, a lot of the interest out. All right. So if you look here, I pulled this off a credit card website. If you look at the column where it says excellent credit, you look down towards the bottom here, it says that if I've had a loan or credit card for 3 years or more with a limit of above $5,000. I learned this a while back, that I found that the 5K threshold is kind of like when you get over that 5K hurdle as far as your credit limit, that's when lenders start to kind of take you serious. Anything below that, they're still looking at you as you got, no training wheels on. So this just reaffirms that 5K limit as far as when we're going to get funding. Once you hit a 5K limit, you have a card with 5K, and you had it for a period of time. And in this instance, one of the data points is 3 years, and you managed it, and you've been able to grow it over that 5K. That's when we go to get funding, we're going to get some much better results. All right, so authorized users. So we talked a little bit about it already, but now let's get into it. All right, so an authorized user is a secondary card holder. The authorized user is added and removed by the primary card holder. The card issuer reports the trade line to the authorized user's consumer report. This can help the authorized user, this is a secondary person that you add on, build credit and establish a relationship with that bank or creditor. The primary cardholder has control over the spending limit and if the authorized user is issued a physical card. Parents can add their children, so they will have established credit by the time they are 18. So there are a number of lenders out there that will allow you to add your child as an authorized user some as early as 13 years old. And you can leave them on there, and this will build up their credit report. So when time they turn 18, they'll have like a 750, 770, or even 800 credit, well, not 800, but a high 700 credit score. And then they could use that to go get money to take your guidance or whoever's guidance and go into business, or go and get into asset, reinvest, or do what they want to do. They can make enough money or have enough money coming in to pay for their own college just off of credit. All right. So this is Experian again, talking about join an account as an authorized user. So again, this is Experian, the largest credit bureau agency in the world, is suggesting that you use authorized users. All right. So you can also improve credit by joining a trusted family member or friend's credit card account as an authorized user. You'll be able to use the credit, you'll be able to use the card to make purchases, and the card's payment history will show up on your credit report. Now, again, the card primary card holder does have say so if the person that they're giving this trade line to can get a physical card or use the card. So let's say you have a credit limit of $10,000 and you add someone on to help them build their credit as an authorized user. You can tell them, I do not want them to receive a card, and I also want their spending limit to be $50. So usually they'll that's probably low if they excuse me, if a bank is allow you to go lower than that, you can go lower, but typically $50 is like I think the lower threshold. So even though the limit on that card or that account, that trade line is $10,000, that's what's going to show up on their credit report. Let's say somehow they did get a physical card. They called in and did something and trying to do some slick stuff, and they did actually get a physical card. Well, let's say they try to go to the store and try to run it up. Well, the only thing they're going to get it is $50. That's the highest they can get, right? So again, I'm sure they pay you a couple $100 to add you on, or if they didn't pay you, just helping them out. At the end of the day, you are protected. You're only going to lose $50. All right. So then we have Chase Bank. Chase Bank, the largest bank in America and also in the world. What are they saying about authorized user? So bill credit. You can be an authorized user. So authorized users are typically family members, legal guardians, or trusted individuals of cardholders. But anyone can become an authorized user on another's credit card. So this is from Chase Bank. So let's just go ahead and dispel all the myths. Experian and Chase Bank seem to be agreeing with each other. All right, so let's see here. This is a list of lenders that you can go to add people on as authorized users. So if you have any of these cards right now, or if you know anybody that has these cards right now, you can jump onto their cards and become an authorized user to help build your credit only after and if there is no derogatory information on your credit report. All right. This will not help if you have, in most cases, if you're going to get funding, it's not going to help if you have um, high credit utilization. It will lower your overall credit utilization, but another thing that lenders look at is that they're looking at the individual accounts and the utilization on the individual accounts. So let's say you're maxed out on all your cards and you add a card on there that drops your utilization down to 50% or 40% or even 30%. They're going to look at the cards that are in use and see, are they maxed out and are they over the limit? And then that is going to show that you're a high risk, and it's also going to decrease the amount of funding that they give you if they do give you funding. But then again, these are banks that you can go with. They report out pretty well as far as tri-merging against all three to all three credit report agencies. Some cards don't report out to the credit report agencies. Some only report out to one credit report agency. Some report out to two. But these here have a good track record of reporting out to all three credit report agencies on time. All right, so how do you add a person on as authorized user? One, they're going to need your full name, your social security number, and your address and date of birth. Um, you can add you can add them on over the phone, or even online. You can add them online. Some credit cards only allow you to remove them off. So you remove them off, you have to call in. Some of them don't allow you to do it online, some do. Um, and then on that reporting date, the report out day after the bill cycle is closed on that reporting out date, that's when that trade line is going to pop onto the authorized users credit report. If you add the person on within a week, sometimes 2 weeks of that reporting date, it may not report out on that cycle, so you have to wait to the next cycle. Then it will report out onto that person's credit report. All right, now we get into some of the fun stuff here. So credit repair. Let's see here. Due to illegal and unethical practices, the government put in place multiple agencies to oversee and regulate these private data collection companies. Your consumer file is data you have the legal right to change at any time. All right, so these are some of the agencies and acts and laws and things that were put into place to protect consumers from the credit bureau agencies, from lenders, from predatory practices, from unethical and illegal things. So, as a consumer, you have an arsenal of resources, laws put in place by the federal government. You also have local government laws, so state laws as well. And in some cases, you may even have city or county laws, but you definitely have federal laws over the land as far as protecting you and on your side to help you clean up your credit report and get your credit report to where it needs to be. And then you also have state laws and state regulation as well that helps and protects you. So most of us pretty much know about the Fair Credit Reporting Act, but there's so many other acts as you see that you can use to actually get things off of your credit report. And each one of these acts and all these laws, I mean, they've been put together by groups of legal teams and attorneys and things like that. So they are like super thick books, like super thick manuals and stuff that you got to go through. But if you are patient and you do your homework and do your research, or you know somebody who has gone through it and has become more familiar with the laws, you can get together with them to help you remove things off of your credit report. So you have the right to change, add, remove information from your credit report based upon federal and state law. All right, and so these are the three different ways that you can challenge, repair, dispute, uh, credit, right? Fixed credit. So you have Metro 2, which is a compliance. You have consumer law protection, consumer protection law, and then you also have factual dispute. So Metro 2 compliance is the standard format for financial institutions to electronically send data about a consumer to a consumer reporting agency. So with Metro 2, you are challenging, which is a coding system. Metro 2 is a coding system. What it happens is that it converts your dispute into different codes, and then it sends it through the credit report agency. And then when you're disputing, the system converts your disputes into codes, and then it disputes. So if you understand Metro 2, you know how to write the letters for Metro 2 and use the codes. You can use those codes to communicate with the Metro, the compliance computer, to get it to delete things off of your credit report. And then you have consumer protection law. This is pretty much like being a lawyer or being a paralegal. This is literally understanding the laws and using the laws and really setting the credit report agencies up for lawsuits and litigation to get them to delete things off of your credit report. And then you have factual disputes when you're actually disputing the factual information or evidence about that particular account with the credit report agencies or with that particular data furnisher. So these are three different type of ways of how credit is repaired, cleaned, or fixed, or however you want to say it. All right. So items on your credit report that you have the right to challenge. So it had to be your personal identifiers, your names, addresses, phone numbers, uh, places of employment, email addresses, spouse names, household, siblings, children. Like there's a lot of information that they have about you that you don't know. So late payments, foreclosures, bankruptcies, collections, charge-offs, repossessions, liens, judgments, incorrect information, inquiries, and identity theft. You have the right to challenge and remove all of these things off of your credit report, no matter how long it's been on there. You have the right to remove it off. Anything on your credit report can be removed off. Okay. This is a question that people just always ask. Every time I say that, people ask the same question like 3 or 4 times. Yes, any student loans, child support, in anything on your credit report is a trade line, whether it be positive or negative, whether it's a collection or lien or child support, it's all trade line. So anything on your credit report can be challenged and removed off. Anything on your credit report can be challenged, disputed, and removed off. Anything on your credit report. All right. So according to the Fair Credit Reporting Act, all data must be 100% accurate, timely, and verifiable. So some of the things that we could challenge or dispute is, and this is what we be going through like factual disputing. So it'd be like the account name, um, the account number, the credit limit. We can dispute that. We can dispute the highest amount ever borrowed or charged up on that card. We can the current balance. We can dispute that. We can dispute the status. We can dispute the opening date, the last activity date, the last payment date, the last late payment date, the status code, the comments on the account, and more. So anything about that account on that account, we can dispute it and have the whole account deleted and removed off your credit report um, because it is not 100% accurate, timely, or verifiable. So even if, let's say, you got a collection on your credit report and you opened that account or whatever happened, you messed up, went bad on it. Even though you know that's your account, the collection agency knows that's your account, you can still dispute that account and dispute the discrepancies on that account and get the whole thing deleted off your credit report because it's not 100% accurate, timely, and verifiable. All right. So when you are submitting a dispute and you are looking, when they say verification or verified or this count was verified, right? There is no actual verifying or verification process or system that's actually going on. There's nobody actually checking to go through that account and verify the information or anything. It's not, it doesn't happen. What's happening is when they say verified, is that the furnisher that put that trade line or gave that information to the credit reporting agency that put it onto your credit report, they're verifying that they are reporting this information to the correct consumer file. That's the only thing that they're verifying. They're not verifying the any of those things that we talked about, the accounts, number, status, the payments, dates, histories, anything. They're not verifying any of that. They're only verifying that this is the correct consumer profile that we're furnishing to. That's it, right? So um, that's something that we should understand as far as like when we actually cleaning up our credit, when we're going through these things and understanding what these terms mean and what's actually going on behind the scenes. So oh, and a lot of this stuff, all the stuff is going to be going through eOscar. So eOscar is it's a web-based Metro 2 compliant automated system that enables data furnishers and credit report agencies to create and respond to consumer credit history disputes. So eOscar is again, and this is what Metro 2 compliance disputing, it communicates with eOscar to get things deleted off of your credit report, using different coding and language, back and forth communicating with this thing in code in a coding language. So um, with the Oscar, every dispute, whether it's electronic or a physical paper dispute through the mail, there's no human being actually reading those disputes. They just open the letter up, they scan it through eOscar. The eOscar creates a code, a Metro 2 code or whatever, and then it sends it on. That's it. And that's just how it works. And when you send that letter in, it reads the code, I mean, reads the letter, converts the dispute into codes and then sends that code to the Oscar computer at the data furnisher, that lender, that bank, and then it picks the codes up and then it reads whatever it needs to do, and then it sends codes back to eOscar, and then that converts back into whatever appears onto your credit report. So with Metro 2, um, it's also a coding, Metro 2 disputing is also a coding process that when all this coding and stuff is going back and forth, these computers are talking to each other. Metro 2 is going in there and it's sending codes and putting codes in there and having it dispute and look and verify and look up certain things and validate stuff or whatever, and check certain metrics and certain different things that this computer knows that you don't know. And if the computer can't doesn't find that it is, right, 100% accurate, timely, correct, or anything like that, it's going to delete it. So that Metro 2 is a powerful way of disputing, but so are all the rest of them. So is consumer law. So is factual disputing. They're all very powerful ways to, if you understand how the system works and how to use it to your advantage, they're all very powerful ways to dispute credit. All right, so prepping your credit report for disputing and for challenging. So one is you only want to have one name associated with on your credit report, and if you're cleaning off negative items off your credit report, you want to remove any names that are associated, because you can have a whole bunch of different names on your credit report, but you want to remove any names if possible that are associated with that derogatory account. You want to verify that your social security number is correct. You want to remove any addresses that are associated with that negative account. If you don't know what, you can look up to see what address is on there, but if you don't know, you can literally just call into the credit report agencies and they'll tell you which address that trade line is connected to. And then you can just focus on getting those addresses removed off, because that's how they verify. Again, they just verify that they have the right person. So then you remove all the old previous addresses, remove employers because they can use employers to put collections and things like that. Not going through your job, but they can use that you work at this job. So let's say you apply for something and you put your job on the application, and since the lender has that information, they can say, okay, well, this person works at this job or whatever, and they can use that to link it to your credit report. Also, any spouses, roommates, anybody else that's associated with your address, oftentimes they are also on your credit report, and which also allows their bad credit to be reported to your credit report because their names and things like that are associated with your credit report. Especially if you live in a house and you're like a junior or a second or a third or something like that. Oftentimes the credit reports will get mixed up and merged because of those names. So you want to get rid of those old ex-girlfriends, old ex-husbands, or roommates and things like that. Get all that stuff cleared off your credit report. Remove phone numbers because they can use phone numbers. The phone numbers that's on your credit application, they can use that to tie it back to you. Verify they got the correct date of birth on your credit report, and then remove any email addresses because they can use those as well to tie that account back to you. All right, so here are some of the examples of like laws and things of that nature that we can use to dispute our credit. Let's see here. The FACT Act. Okay, so FACT Act section 312 describes the manner in which debt collectors can report to the credit reporting agencies. So Section 312, procedure to enhance the accuracy and integrity of information furnished to consumer report agencies. Review the methods, including technological means used to furnish information relating to consumers to consumer report agencies. Determine whether a person that furnished the information to the consumer report agency maintained and enforce policies to assure the accuracy and integrity of information furnished to the consumer report agency. So the FACTA Act Section 312 is so powerful because Oftentimes, uh, collection agencies, lenders, they don't do this. They're supposed to have in-house procedures and methods and all these kind of different rules and different things like that. That they're supposed to make sure that everything that they report onto your on your credit report, they have double checked it, triple checked it, verified it, validated it, all of that. But that's not how things get onto your credit report. So they violate this law all the time. What happens is they simply pay the consumer reporting agency to report, and then they just send a batch of accounts and information every single month to the credit report agency. And since they're doing so much mass uh, transfer of data and information and reporting, they usually are not going through and meticulously or even responsibly, making like reporting this stuff out to your credit report. So anything that data furnisher, that creditor, that lender says about you, they'll just report it. Whatever the dates are, whatever it is, it could be incorrect. It can be the wrong name. It could be even not even your account, and they'll still report it out to your credit report. And so what this is, so that is a violation of the FACTA Act or the FACT Act, Section 312, and you can send off a dispute using this law in particular because they're just not following this procedure. And you can challenge that derogatory account based upon challenging uh, that data furniture with this law. And you can get things deleted off your credit report that way. All right. So United States Code 1681 I-7. So this is talking about the method of verification. A consumer report agency shall provide a consumer a description referred to in paragraph 6B3 by not later than 15 days after receiving a request from the consumer for that description. So you can send off a dispute letter. They say, okay, we verified it. Excuse me. And you can ask for a method of verification. How exactly did you verify this? You're asking the credit report agency, how exactly did you verify this account? Did you call somebody? Did you have a witness? Was there, can you give me the name of the employee that verified this account? Are you swearing by, your means that everything is accurate and correct on that you actually verified this account? So when you ask for that, they have to give you the exact method of how they verified this account. And if they send you a letter back talking about like they verified it through a consumer report agency or another database or something, that's not good enough. Because you can't, the only person that can validate or verify an account is a person that originally opened the account. That's the only person that can actually validate or verify an account. But so the actual original creditor or the original data furnisher that you open that account with is the only person that can furnish that to your credit report, or verify any information or validate any information about that account. They cannot go through a third party company or anything like that, or verify it through another reporting agency or something like that. And once they tell you that they use an unlawful way to verify or validate that account, you can send another dispute letter. And especially if you didn't receive it in 15 days, you can send another dispute letter for disputing that too to get that account deleted off of your credit report. Okay, so United States Code 1681 EB and United States Code 1681 I-5. This is talking about the accuracy of report. If after any reinvestigation under paragraph 1 of any information disputed by a consumer, an item of the information is found to be inaccurate or incomplete or cannot be verified, the consumer report agency shall promptly delete that item of information from the file of the consumer. So you can send a dispute with these. You can look these codes up. see which one fits best for your particular situation, and you can send a dispute. Just let them know, okay, this account is in violation. It's not reported 100% accurate. All right. And they're going to have to go, they're going to have to try to find, make sure that they got to go back to the data furniture to try to verify or validate this, make sure this is 100% accurate. Sometimes they may come back, but oftentimes they'll have to delete it. They have to delete it off there. And you can keep going back saying this is not accurate. And this is why it's not accurate. This is incorrect. This is incorrect. I found this, I found that, which is factual disputing. All right. So US Code 1681 2B, and also using these US codes, these United States laws, is a part of consumer law, like practicing consumer law. So exclusions from a consumer report. I'm just giving you examples of different laws and resources that are out there that are empowering you to do what you got to do to get your credit report right. So a person who B has furnished a consumer report agency information that the person determines is not complete or accurate shall promptly notify the consumer report agency of that determination. Determination, and provide to the agency any corrections to that information or any additional information that is necessary to make the information provided by the person to the agency complete and accurate, and shall either thereafter furnish to the agency any they'll and excuse me and shall not therefore furnish to the agency any of the information that remains not complete or accurate. So what this is saying is that um, one, you should understand that a person is a company, is a corporation, is a data furnisher, is a lender, is a bank. So they're saying that, if this data furnisher, this person, this lender, this lending institution determines that is incomplete or inaccurate, they are obligated to correct it or delete it, have it deleted from your credit report. So let's say you dispute a late payment or something like that, or dispute information about an account that is inaccurate. I've had accounts pop up on my credit report that was not mine, and I had to dispute those off. So once they find that it's incorrect, not timely, inaccurate, incomplete, they have to either correct that late payment, change it from a late payment to either no data, no information, or to on time payment. Or if it's another type of account that's being disputed, they have to delete the whole thing off of your credit report. All right, so debt validation. So United States Code 1692G. A consumer has the right to challenge the validity of any debt. The creditor is required to provide complete written documented proof. If you don't respond to a creditor within 30 days, the creditor can assume that the debt is validated or valid. If a creditor doesn't respond to your request for validation within 30 days, you can assume the debt is not valid. So when it comes down to requesting validation of a debt, they may send you a collection letter, a bill statement, or they may send you a packet with a bunch of credit card statements in it. That is not, and when most people get, they're like, oh man, they got me. That is not debt validation. That is just a stack of credit card statements. That is not debt validation. That does not mean that that account is validated. That is another resource or weapon for you to go through those statements, find inaccuracies and discrepancies, so you can delete this account off your credit report. But if you get a collection letter or some type of letter in the mail, most people throw it away, they ignore it, or don't know what to do, or they call in or something like that. If they communicated to you in writing, you want to respond to communication back in writing. Okay. You want to send them a letter within that 30-day period disputing this debt or this account or whatever they're alleging against you. And either before it hits your credit report, or if they already hit your credit report, which and sometimes and most times when they first send it to you, it hasn't hit your credit report yet. But to prevent it from hitting your credit report, you want to respond back with a um, cease and desist, validation, verification, a number of different things that you could respond back with to keep it from reaching your credit report. Now, if you send a dispute to them and they don't respond to you in 30 days, then it has to be deleted from your credit report or it cannot be put onto your credit report. All right. So again, if they send you a statement or a bill or something like that, or a packet or a list of, a packet of statements, again, that is not validation of debt. These are list of some of the things that validates. So if they cannot provide all these different things here, that this account is not validated, and it has to be deleted from your credit report. So that'll be the agreement with your with clients that granted you the authority. So if it's a collection agency, they have to have a contract of who gave them the right to collect on behalf of them. So a lot of times, banks or lenders or whatever, they'll have like their own in-house collection department, or sometimes they outsource to a third-party collection agency. It doesn't mean that they sold that debt to the collection agency. It's just that they're acting as a custodian on their behalf to do the legwork, to make the phone calls, to collect the payments and things of that nature. And then in other instances, they actually sell that debt off to a collection, like a debt buyer. And then that debt buyer has an in-house collection department or third-party collection agency that collects for them. So you can determine if the original lender still owns and holds that debt and is collecting on it, whether it be their own in-house people collecting on it, or they hired a company to collect for them, or it's been sold off to another collection agency or debt buyers, and then they have a collection agency collecting for them. So if it's been sold off to debt buyers, then you have a major upper hand as far as getting that off of your credit report. But either way, I mean, it can still be disputed. So there's a number of different things on here as you see as it goes through, like um, an agreement that bears the signature of the alleged debtor, any insurance claims. So if you default on a debt, usually these credit cards, loans, mortgages, they have insurance policies on them. So if you default, that the lender puts in an insurance claim and they get their money, and but they're still, even though they got their money and it's been paid off, and oftentimes in some cases, you as the consumer is paying the premium on that insurance policy. Every time you make a monthly payment, you're paying the premium on that insurance policy. So if you default, they cash in on that insurance policy that you've been paying the premium on, and they're paid off, they're made whole, but they're still holding on to your credit and they're still going after you. So they have to make sure that the account number, the address of the alleged, the information of the creditor, the information of the debtor, their address, names, dates, all the accurate reporting as far as like when it became payable, when it became delinquent. There's just a number of different things on here. But a complete accounting of the alleged debt. Again, sending you a bunch of credit card statement is not complete accounting of the alleged debt. Okay. Any commission debt collector. So if a collection agency, if they're receiving any type of uh, payments or compensation to collect this debt on their behalf, you need to know about that as well. Name and address of the bonding agent for the collection agency. So collection agencies have to be in compliance, whatever state that they're set up in, as far as to be able to collect debt. Also, collection agencies are not, most of them are not able to collect debt in all 50 states. So in your validation process, you can, even though that account is still with the original lender that you did business with, or if it's with the collection agency, they could have a third party company. So let's say you live in California, and the bank that you borrowed the money from is in Pennsylvania, and the collection agency that's contacting you for this debt is in Texas, right? So because of these different places, since you live in California, that collection agency in Texas may not even be legally able to collect debt from residents of California. Or they may only have a license to collect debt in Texas, Tennessee, Kentucky, and Florida. But they're buying bulks of debt and they're just calling and emailing, mailing people all over the country, even though they do not have the authority or the bonding or licensing or credentials to collect debt in your state. And if that be the case, then they can kick rocks. You write them a dispute letter, let them know, hey, I know that you cannot collect debt in my state. You need to go ahead and delete this, and you wasted your money buying this debt. So go ahead and kick rocks. Typically, what they'll do is they'll one or two options. They will either just delete it and just wash it off, um, just write it off, or they'll try to sell it to somebody else that collects on debt. And let's see here. All right, so here's another one that I've used before as well, and this is the more so like consumer law disputing, and this is called the estoppel dispute. So estoppel, in layman terms, what it means is that if you write a dispute letter, and this happens a lot with credit report agencies when they do stall tactics, they don't respond to your dispute letters. They ignore you, they throw your stuff in the trash, they don't go through with the dispute. So let's say you send a dispute letter and you're challenging this account or whatever that you're disputing, and nobody responds to you. Crickets. So then you send the estoppel letter right after that. You say, okay, all right, I sent you a dispute letter. There was no response. So according to the estoppel law, is that since you refuse to respond or communicate me and uh validate this debt or whatever I asked of you, I am legally free to assume that this debt doesn't exist. And because of your silence, you agree with me with your silence. And then so if they don't respond to you and there's still no communication, you sent it off uh to the credit report agency or to the debt collector or whoever but I would send it through the credit report agency. You can send it directly to the debt collector, but I would send it through the credit report agency so you can have a more track record, more a paper trail. But the stop alert is saying, okay, since you're ignoring me, you're stalling, you're not responding to me, I am legally safe to assume that this debt doesn't exist. And by your silence, you are agreeing that this debt doesn't exist and it has to be removed from my credit report. So again, you got plenty of tools here to work with. So here's another another example of negotiating that you can do. So sometimes we get frustrated. We don't want to put the time in because credit repair does take time. It takes time. It takes patience. It takes diligence. It takes strategy. It takes good experience to be really effective with credit repair. You can do credit repair yourself. That is something that is very much possible if you just put the time in just to do it. But most people they'll hire someone to do all the legwork for them, right? To help bear some of that headache. But so the pay for delete method is a method that's been used for years and years and years and years. Basically, how the pay for delete method works is let's say you get to a point where you've been disputing, and they're just not taking it off, or you need this deleted in a fast period of time. You don't have time to go through the dispute process. You can call into the call center and talk to a manager, because that call center is anybody can act as a manager or play like they're a manager on the phone. They can literally just hand the phone off to the person in the cubicle next to them, and they'll just pretend to be a manager. But basically, what you want to do is you want to get a in writing, an email or a fax from with a signature of someone says they're a supervisor or manager, stating that you negotiate a settlement for the debt, and then you say, okay, all right, put that in writing, an email or a fax to me, saying that we're selling debt for this amount, and it'll be, done for, and that you will delete this from my credit report upon, receiving this payment, right? And make sure that, again, they have the email signature, who you're talking to, you write down who you're talking to, the date, name, if they got badge numbers or whatever, so they can, you can find track this person back down. It's, it's just not a ghost. And then so you make your payment. And then typically it could be two bill cycles before it updates or deleted. Once you make your payment, you can send another dispute in with that to the credit report agencies with that letter saying that this account was agreed, it was paid. This proof of the payment, has received the payment, and they agreed to delete this. They're going to verify that with the collection agency or the debt collector. And to get that deleted off. Sometimes they will have to send a couple letters to get it done because they don't always do it right away. But yeah, that's the pay for delete method. If you have medical collections, so there's been a lot of changes with medical debt and medical collections, and one of the main reasons for bankruptcy in America is medical debt. So the Fair Credit Reporting Act permits health service providers and their agents to furnish information relating to medical debt to the consumer reporting agencies. However, the act requires furnishers to encrypt certain details to protect the privacy of the consumer's privacy. And let's get into that. So we have HIPAA. So the HIPAA Act is something that oftentimes when I used to do credit repair, I would use this method to back the collection agency into a corner to get that because hospitals, doctors' offices, they don't collect their own debt, right? They always outsource that to someone else. They don't have time to be calling and collecting debt. They gotta perform their procedures, right? So what happens is with the HIPAA laws, you have a right to privacy. And then what you would do is the method we would do is like so any like details about and this is what happens when you validate debt. They're supposed to give you details about what that account was, what was purchased, when was purchased, all this different information, right? So with the HIPAA laws, if you contact them and say, okay, can you validate this debt? Can you prove that I actually had this service or this procedure at this time? Who can you tell me what doctor performed this, what hospital performed it, what doctor's office, how much did it cost? Do you have a bill or something like that stating, showing like what procedures were done and also type of itemized um bill or something like that or invoice showing that I owe this money or that I actually received services or anything like that? Can you show me? Can you validate this debt? If they provide any of that information, it's a violation of HIPAA. With a medical debt, they cannot provide detailed information about a procedure or any real information about what took place for that medical service or whatever that procedure, whatever services that you received, they cannot provide. They're not supposed to. They do sometimes, but they're not supposed to. But if they do, then you can set them up for a lawsuit with HIPAA. And you can threaten them with that and say, okay, all right, you violated HIPAA laws. You need to go ahead and delete this off my credit report because I got a lawsuit coming behind this. Right. So you can sue them that way. You can get things deleted that way as far as leveraging HIPAA. All right. So recently with the Biden administration and Congress, they made some changes about how medical debt is reported to the consumer report. So July 2020, so paid medical collections are to be removed off your credit report. And then they're moving, usually medical collection have to wait 6 months to be reported to your credit report. Now is 1 year, so 12 months now. And then April 2023, all credit report agencies announced the removal of unpaid medical collections under $500. So if you have any type of medical bills, ambulance ride or something like that that wasn't paid and it's under $500, it's not supposed to be on your credit report. And if it is on your credit report, you can get that deleted off. All right, public records. Public records is always fun, right? All right, so public records. Okay, this public records is public information. Anyone can look them up or get access. Consumer reported agencies pull your public records from the PACER database. The courts and government agencies do not provide information to the credit reported agencies. Nexus, Lexis, and ARS sell information to Experian, Equifax, and TransUnion. So what this saying is that anything that goes onto your credit report has to be furnished and verified and validated by the person who lent you that money, who opened that auto loan, who opened that bank, whatever it is. Anything that's furnished to your credit report has to come from the original person or company that opened that or created that credit for you, extended that credit to you. It has to come directly, it has to come from them. So in the case of public records, this information is not coming directly from the source. It's coming from third-party sources. So anything that's coming from third-party sources can be deleted, can be disputed and deleted off. So how we do that is one is going to understand, okay, where they're getting it from. So they're getting it from this website called PACER, right? Public Access to Court Electric Records. So they create an account on here, and then they just continuously every day they just scrape this database for information, and then they take this information and they sell it. This is free free information. Public information is free information, and they sell it to the consumer report agencies to put it onto your credit report. So um, the the public access to court electronic records, PACER services provide electronic public access to federal court records. PACER provides the public with uh, I'm sorry, instantaneous access to 1 billion documents filed at all federal courts. So what this is that if anybody ever wanted to look you up, look up legal, if you ever been sued, if you ever, had anything to do with, court, yeah, anything like that, anything that's dealing with, legal, if anything like that, they can look you up, right? So this is how like journalists, lawyers, obviously the credit report agencies, but different individuals who want to do a background check on you or check you out to see what you're about. If you ever had any legal action and things like that filed against you, they can go to like a PACER or all these different databases to pull that information, and they just pretty much just set up in a login, and they can just go through and just surf anybody's records, anybody's background. So that's how that works. So again, it's not coming directly from the source. All right, so this is a method of how we get public records deleted off the credit report. So one is um, prove the public record is unverifiable. So that's what we're going to do to get it deleted off. So one is we're going to send a letter to that court. For this is an example, if it's a bankruptcy, we're going to send a letter to that bankruptcy court. We're going to simply ask them, do you verify court records or bankruptcy records or anything you verify with consumer reporting agencies? Simple, 1, 2 lines, 3 lines at the most. Do you verify this? Did you verify this information with the consumer reporting agency? And then you're going to put in there a envelope that's stamped with your address written out for them, so they can just print out their automated letter, put it into your return envelope with stamp on it, and then drop it into the mail and send it back to you. Simultaneously, you're going to send a letter or you're going to request your LexisNexis consumer report. Should be a very thick report. Most oftentimes it comes through email, through a PDF file, and then you're going to get that report at the same time that you do this all the same day. You send off your letter and you get the report the same day. Then you're going to request the method of verification from the credit report agencies that this public record is on. So again, you do all this the same day. You're going to send a letter off to the courts. You're going to get your Nexus Lexus report, and you're going to send a letter to the credit board agencies asking for a method of verification for that public record. And then you're going to start getting stuff back in the mail. You're going to get a letter back from the court saying, no, we don't verify. You're going to get your LexisNexis consumer report, which is where the that bankruptcy is reported to. And this is where the ARS gets it, and Pacer, they sell it to Lexus. And then you're going to dispute the record with Lexus saying, okay, I got a letter from um, the court saying that they did not furnish this information to you, that it's not verifiable, so you have to delete this off. You're going to have the letter from the credit report agency saying that, we verified with Nexus Lexus, or we verified with ARS, or we verified with Pacer, which is a violation because it's not coming directly from the source. And if they say, oh, we verified, sometimes they say we verified with the courts, you can send them that letter from the court saying that they don't verify. So you can trip them up in their violation in their laws because they do this every single day. All right. So then what you're going to do is once that Nexus Lexus report has is cleaned, that public record has been deleted off, you're going to send the Nexus Lexus report. You're going to send a letter with the from the courts saying that they don't verify with the credit reporting agencies, and you're going to say, okay, you need to delete this off because the source that you say that you got it from does not have a public record, there's bankruptcy on there, and also the source that you may claim, what you did claim that you verified it with, which is be the courts, say they actually don't verify with you. They have no communications with you at all. So this is a violation. This is not 100% accurate, not 100% timely, not 100% complete. So it's not 100% verifiable, right? So it's one of those or all of those, and it has to be deleted off of your credit report. And you do that with Experian, TransUnion, and Equifax. Sometimes they may not delete it on the first letter. You may have to resend it, redispute a couple times, 2 or 3 times before they actually delete it off. Most of the time, they like to be stubborn or just stall or just not remove it just because you caught them. But a lot of instances they do just delete it off. But again, sometimes they like to be stubborn or try to stall to frustrate you to see if you're still going to push the envelope, but stay consistent, push the envelope until it gets off. It's a little legwork, but it's worth it, right? All right, so we have Lexus, ARS, SafeStream, CoreLogix, Factor Trust, Clarity Services, and Innovis. All of these companies are subsidiary companies of Experian, um, Lexus, um, TransUnion, and Equifax. So these are subsidiary companies that they also use to collect data, sell data, and verify data that's on your credit report. What's pretty much they're just using their own company to verify data that's on your credit report, which is illegal, and which is why those things need to be deleted off your credit report. So a lot of people say, go freeze these agencies or whatever, but that used to work, and you can still try it. But what happens is since these are subsidiary companies of so like for example, Clarity Services is a Experian company. Factor Trust is a TransUnion company. So, but since they are in the same family, even though you freeze them from lenders uh, collecting information about you from these particular credit report agencies, they can share information with each other because they're sister companies. So when you freeze them or when you block them or whatever you're going to go do, that stops when you apply for credit. That stops lenders from seeing what's on these reports, but it doesn't stop Clarity from sharing information with Experian, which is his sister company, or Factor Trust sharing information with TransUnion because that's his sister company. They can share. They have bylaws within themselves or privacy laws within themselves that allows them to share information across their own family or own network, right? So just keep that in mind. And also, these companies are also used when they can't get access to, like when they're doing soft pull credit or different things like that, and or for consumer loans and consumer credit lines and things of that nature. When they're not going to get access directly from Experian, TransUnion, Equifax, they're using these subsidiary credit report agencies or consumer report agencies to actually pull credit reports, pull they're not getting technically they're not getting FICO scores, but they're pulling your credit report and they're processing it through their own algorithm to produce a risk score and approve you for credit. So if these companies are froze or locked or blocked, it's going to stop you from getting approved for credit sometimes, even though they did a hard pull on the Experian or Equifax or TransUnion. And if you're trying to get approved for like a soft pull credit card or something like that, they actually go to these companies, and again, since they're sisters, they can pull your Experian report through Clarity, or they can pull your TransUnion report through Factor Trust, right? And so they can get that information and use it to determine or give you approval for credit for funding. All right, so when we're going to get business funding, we're going to have to make sure that we are managing our bank relationships well, because oftentimes when we're going to get business funding, we're going to be going to, there's thousands of banks that we can go to and different products we can get from many different banks. And oftentimes we're going to have to start a relationship with those banks to be able to before we go and start applying for them since we're new customers. And we're going to have to deposit money into those accounts to uh, initiate that relationship and increase our ability in our eyes to get approved for a high limit credit line or credit card or credit or a loan or something like that, right? So maintaining our personal bank accounts and maintaining our business bank accounts that we do have, that is very important, because those our current relationships with the banking industry or banks, um, they have a process where they develop their own scoring ranking methods, and also they have a data system that they share amongst themselves, that that they have a scoring model for your bank account. So your bank account also has a credit score. I hope I said that clearly. So there's a bank rating, which is something that individual institution or bank rates you on or develops for you. And then there's a third party company that collects the banking your banking information, and they use that to share amongst the whole banking industry. And then they create actually a credit score or banking score for you. So right now we're going to be talking about the bank rating, how to get a good bank rating, and then leveraging those bank credit scores and those bank ratings to get approved for business funding. I hope I didn't confuse you guys with that right there. All right, so Fidelity National Information Services owns eFax. eFax owns Check Systems, and this is probably one of the names you probably heard of before. Check Systems, if you ever closed an account, had a checking account closed or went delinquent or whatever. So Check Systems is what generates your bank score, which is different from the bank rate. So this is a credit score that banks use, that they pool when you go to them and you want to open up a consumer account or a business checking account, right? So they're going to pool your credit score for your banking credit score, right? And then so the banking credit score with Check Systems, it goes from 100 to 899. The higher the score, the lower you are as far as a risk. All right. So Check System keeps reports on like insufficient funds, fraudulent activity, if you ever had account shut down, unpaid negative balances, things like that. It keeps track of all those different things when it goes into creating. And you can actually dispute any consumer report agency. You can dispute this information, so you can dispute Check Systems and get. If people say get out of Check Systems. you don't want to get out of check systems because if you're getting out of check systems, you no longer have a bank account score or a bank's consumer reporting score, right? So that means you're high risk. So when they say get out of check systems, what they really mean is that you have a low score. If you're, they say you're in check systems, that means you have a low score. So you can dispute this information off of check systems to boost your score up, and that's what they people say get out of check systems. So you don't really get out of check systems. You just boost your score up, just same way you boost up your TransUnion score or whatever, right? So hope I say this right. Qualifile. So it's a real-time demand deposit account, which is a checking account, organization solution that uses behavioral risk uh, segmentation to ensure you open the right bank account, the right account in any channel based on your institutional's that institution's risk strategy. So basically, what that means is that for example, if you ever got like a fraud alert on your credit card or for your bank account from some suspicious activity, that's because this company right here is real time monitoring all your activity and creating profiles on you and watching your habits. And when they see something that looks suspicious, or even if it's not like a big account charge coming through, like right, they'll be able to flag and say, "Is this you? You know, did you make this charge? Did you because this is unusual behavior, right?" So these companies they track you uh, like over time, and they track you every single day, all time. So there's a lot of tracking going on behind the scenes when it comes down to like your bank account, and most people don't know this. And so again, we can give the bank the information that they want. So when they pull our credit score from check systems and they look at our bank rate, they can extend us funding. They don't even have to go to Experian or TransUnion or Equifax. They can use their own internal data from check systems, from Quillifile, whatever, to be able to give us funding that we need. So that's another way of how you can get funding without even using your FICO score. All right. So the rating factors. So the initial deposit, positive cash flow, and account seasoning. So the initial deposit, maintaining a strong daily balance. A checking account is not a savings account, but there should always be money in the account that you don't touch. No overdraft or insufficient funds. Add overdraft protection if offered. So what this is saying is that that initial deposit that you put into the account is going to generate a rating for you. It's going to let the bank know that you are a potential um, spender, high roller. You got good money coming in or whatever, right? It's going to put you start that profile for you looking like that you are one of those exceptional um, customers that they want to keep for a long period of time. Um, and then as far as like in your business bank account, there should be a amount of money in there, like 10 grand. And I'll show you the amounts, but there should be an amount of money in there as your expenses are coming out and you're paying bills and money's coming in, coming out, going in, coming out. It should not be dropping below a certain threshold as far as like on that bank balance, which is going to help you with your bank rating and your banking score. So you're going to have positive cash flow, going in and out of um, your account. Your expenses should never exceed the revenue that's coming in. So you should never have more drafts coming out of the account or large amounts of drafts coming out of the account than deposits and money flowing into the account. That means like you're negatively cash flowing, so banks could take that in consideration as well. And then account seasoning, that's how long your bank or your business is maintaining this bank account. All right, so these are the ratings. So where we want to be is we want to be in um, in the fours, the high fours, or the fives. If we can get into the sixes or higher, that's even better. But most of us just have a good rating. This is considered good ratings, the four or the fives. So if you are um, in the low fours, like you, that's you got to step your game up. So typically, like where we want to be is more like the high four. If we're going to be starting out, we want to put at least 5 grand into account. But if we can do more, we can do that's great. But if we could initially deposit like a 10 grand or a 20 grand into an account, which will put us in the low fives, that will give us a great bank rating. With that bank coupled with, since we have no track record with that bank, it'll be coupled with our FICO score, and then we can go ahead and initiate getting lines of credit, funding for loans and credit cards for our business. All right. And as we know, or if you don't know, one of the primary reasons why small businesses fail is lack of funding or working capital. And a lot of that has to do with not investing back into the business properly, not having enough capital on hand to invest back in the business, to be able to expand and grow at the way it needs to be grown. All right. So the stages of funding your business or business funding. So we have what's called pre-seed funding, which is a lot of what we're talking about or what we're doing here, what where I'm offering here, which would be pre-seed funding. So this is typically pre-seed funding is typically when people like, they'll fund their business from their paycheck. They'll fund their business from savings. They'll fund their business from taking money out of their 401ks or retirement accounts or insurance policies to fund their business. They'll take uh, a loan against their home or a home equity line of credit or something like that against their home to fund their business. All very bad ideas, because there is plenty of business funding available for you to conduct business. You don't have to ruin your personal finances or go into all this personal consumer debt for the business when you can just allow the business to go into the debt for the business. You keep your personal finances strong so you can always go back and get more money, more credit, more funding for the business to do business. But we mess this up. So many people mess this up. All right, so 50 to a $500,000, $50,000 to $500,000 is usually what people are able to raise in the pre-seed funding process. Another method is what they'll go with friends and family. That doesn't necessarily mean like your cousin, your mom, or whatever. It's just people that's in your network. It could be coworkers. It could be literal friends or literal family members. It could be people from a social club, the people you work about at the gym. It could be a number. It can be a stranger on the street. Um, so that's just the friends and families, people in your network. There's also, your rich uncle could be an angel investor, or your cousins can be a silent investors. So raising that money can sometimes damage relationships if it doesn't go right, if they don't get the returns that they're expecting. But if you do have that support, that's great, but you don't need them because you have business funding. And business funding, you can get more money faster without all of the obligation that comes along with having an angel investor or these silent investors, when oftentimes they are not silent. They want to know what's going on, what's happening. They call you every single week. Did you make that sale? Did you make any money? Blah, 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 right? So you can eliminate all that, and you can have a real silent partner, which is the bank, and you can get business funding, and you get more money faster than what you have to wrestle these people for. All right. So then you have seed funding, which is like up to $2 million typically. And this could be like startup incubators. This could be early stage venture capitalists. Typically, venture capitalists, they want to go for bigger fish, or people later on down in their development stages. But you have some that are interested in like these little small caps of a couple $1 million. Then there's also crowdfunding that you can also do to raise money. So you actually offer that up to the public. Um, you know, donate to this fund, and this is what we're doing with it. and people can put money into the fund, and you can use that to invest into the business. But again, uh, with the business funding, we can be creative, and we can even get business funding that exceeds this the seed funding stage, right? And every we should understand that every uh, time we go for funding, it should be enough funding to operate the business, to withstand the business, maintain the business, and grow the business to the next stage in your business plan. Because each stage you're going to go back for funding. So the funding should be able to hold you over, to hold that business, to grow that business, to give it everything it needs to get to the next stage to raise capital, to raise funding. So that initial funding that you get is not forever. That's just for right now, because you're always going to be raising capital and going after more funding as you grow and expand your business. So then you have Series A, which is when you really start. This is like the real legit like capital raises. So this could be $2 to $10 million typically. At this point, your business is going to need to have a proof of concept. It's going to have good predictable revenue coming in. It has sustainability and growth. And this is typically where venture capitalists come in, and they gonna want to start investing into your company or putting money into your company, and as in exchange for shares or stock in the company. Typically, this is with the C corporation, because C corporations can go through all these different series and raise the most amount of money. LLCs cannot do a Series A or anything type of like they can do the rest. They can do pre-seed. They can do all those other seed stages, but they can't do Series A. You can purchase the C corporation and put your LLC under that, or you can convert your LLC to a C corp. All right, so that is Series A, and then the point of Series A is to get you to Series B. So Series B, we're raising capital. We're looking for expansion. We're looking to open up more locations. We're looking to hire more people. We're looking to produce more product. We're going into a new demographic, a new market, a new region, a new country. So that is Series B. So Series A, you raise enough money to get you everything you need to do to get you to Series B. Series B, you raise enough money to get you everything this business needs to get to Series C. And Series C is another capital raise, but also in Series C, this is when you are raising capital to go out to partner with other companies or to acquire other companies. And with Series C is the reason why you want to do that, to do mergers and do acquisitions, is because let's say you um the smart way to do this is you would actually go start buying up competitors. Let's say this happens all the time. Let's say you have a company or a product, and you need the um another company's solution or service or they provide to complete your service or your product or make it better. Or you need another company's patent for their or let's say another company is also coming up and they have something that could compete against yours. Or you need that particular type of patent or their particular type of way of doing business to uh, um not to be offered to the public, but only to work for your business, so you can have that competitive edge, right? So that's when you'll go and you start acquiring other businesses. So oftentimes they're not going to sell you like their patent or sell you their product or sell you the rights to the product. So you just have to just buy the whole damn company, right? To get access to that unique product or that unique service or whatever that company has developed. So you can just go buy the whole company. Also, your supply chain. You can start buying your supply chain. So companies that you do business with, companies that you buy from, vendors, things of that nature, competitors. Again, you start buying those up, and then you start putting it under your umbrella of this company. And what happens is your company's evaluation explodes because the valuation, the value, the revenues, and everything and the perceived values of the companies that you purchase now increased or pushed up the value of the main company that you're running. So with Series C is very strategic as far as raising capital because um, now you are really cementing yourself as a business, as a company, and you're preparing yourself for the next stage, which is the IPO or the exit. And this is when you cash out, right? So you've started the business, you got it going, got momentum, you followed the proper procedures, you got the right consulting, and then you've raised the different stages, Series A, Series B, you got the Series C, you increase the valuation of the company. Now your stock and your shares are worth so much more money. And now when you go to do an IPO, they see that this company is worth so much, and then they can estimate to see, okay, how many people are willing to commit to this IPO, and then that is going to further increase the value of your company. And then you can go through with the IPO, initial public offer, raise all that money, uh, some of it, a lot of it goes, well, some of it goes to you, some of it goes to the company, some of it goes to the shareholders, some of it goes to the angel investors or the banks or the lenders, whoever helps you with the different stages in raising funding and raising capital. They get paid off. The venture capitalists get paid off. The angel investors, all the people get paid off. They get their returns. You get what's left, and then the company gets the infusion of cash and whatever else that is needed for them. So everybody gets rich at this point, right? And then you continue on. You can sell the company, or you can stay in the company or whatever you want to do. But these are the stages of raising capital and business funding, right? But I just wanted to go through this process so people understand that this first initial business funding that we do together is just a small step into what is possible out there, and the numbers that you can raise for your business, right? So we want to be strategic with this. We want to take advantage of this opportunity. That's why it's like there's no point of bankrupting yourself using your salary, using your savings, using your 401k, and taking money out and taking money out of your house and taking money out of this and this and that. You don't have to do that because there's so much money available to you. You just have to position yourself and ask properly. That's it. And that's what I do as a coach, is to position you and make sure you're asking the right person the right question to get your money, right? To get your funding. All right. So now let's get into business funding. All right. So what we're going to do is we are going to make a person. All right. So most people think that they are a person, but in business, a human being is not a person. So according to the United States law, the term person or entity means any individual, corporation, company, foundation, association, labor organization, firm, partnership, society, joint stock company, group of organizations, or state, which is like a state that you live in, or local government, which could be a county or a city. This is the definition of a legal person or a legal entity or entity. Person, as defined. A person, the word person or persons, where used in sections 1 to 7 of this title, shall be deemed to include corporations, associations existing under or authorized by the law, either on the United States and any other territory. So again, a person is not you. We are creating these persons to go to the banks for us, to act on our behalf, to be its own separate individual, as it is stated here. It's an individual, a company, a corporation, a foundation. We are creating these individuals to go represent really themselves, but they're like our mannequins. These are our straw men. We are creating these companies, these persons to go into the bank. We make them look great. We dress them out really nice, make them look great, and to go into the bank so they can go get all the money for us, right? A person can get so much more money than a consumer can. right? So now let's look at what we are. We are considered a consumer and not a person, right? This is what how the United States views us. They view us as a consumer. So the term consumer means an individual who obtains from a financial institution financial products or services which are used primarily for personal, family, or household purposes, and also means the legal representatives of such an individual. So a consumer is an individual who obtains from a financial institution financial products and services. So that makes us when we go to the bank to use our social security number, that makes us consumers. But as a consumer, we're limited on how much funding we can get. But our person can go into the bank and say, well, I got this consumer over there. They got good credit, even though I don't have any credit right now. But I'm a person, and persons don't have so much regulation as a consumer. And I really have no regulation at all for the most part. And you can give me as much money as I asked for because I got this consumer behind me that's gonna vouch for me. So we need to understand, what's going on with these companies, with these businesses, with these entities, with these shell corporations, age corporations. They are persons that we dress up nice to go into the bank to get money, to get funding for us. And we stand back and we just be the consumers. All right. So when it comes down to, let's go back. All right, there we go. All right. So when it comes down to, all right, we're going to make our person, right? So we're going to go to the Social Security website and we're going to do a check availability for the business name that we're looking for. If you don't know the website, you can use this website here, e-secretaryofstate.com. It has links to every single Secretary of State website on it. So you just go to your state and then you can get onto your Secretary of State website. You want to check you do this during business hours. You just want to check the name availability for the person that you're looking to create. Before you register that business, you want to check your website and social media handles, domain names. So you go to a website called namecheck.com, and that's going to let you know if that name, those websites have already been taken, or if the social media handles have already been taken. Then we want to get our business phone. This is all before you go register your business. We want to get our business phone number. It should have three numbers. It should have a 800 number. It should have a phone number that has an area code local to the area that you're conducting business, and also should have a fax number. Even though we don't use faxes anymore, it should have a fax number. Why? Because these numbers are going to be important when it comes down to applying for business funding. There is a section or area on the business funding application that asks for a fax number. So if it has a line for it, let's go ahead and have it there, right? All right. So we can go if we again if we're working out of our home or whatever, we don't have a landline, we can go to Grasshopper, Nextiva, or Call 8, and we could purchase a business telephone number from one of these companies. If you are looking to get a second cell phone number or a second number on your personal cell phone plan, that will not work because that number is registered as a consumer number and not as a person number or a business number, entity number. So we want to make sure that you can go to AT&T or Verizon or whatever, and you can ask them for a commercial um, telephone plan, and you can get these numbers that way. And then you can have a Grasshopper, Next TV, or Call 8. They can route your phone calls to your cell phone or to whatever phone that that you're using for business. Also, you want to get a answering service. Some of them offer answering services. So these are people that when they call, they're gonna pick up the phone and say, you reach, such and such company. Who would you like to speak to? Or they'll say, do you have the extension for the person you'd like to speak to? You say, no, I'm looking to speak to such and such in customer service, or such and such in sales, or such and such in and wherever, and then they'll say, okay, hold one moment, and then they'll put that person on hold, and then they will call you and say, okay, I got a person on the phone, they're looking for this, that person, that, and the other, and they'll say, okay, you say, okay, put them through, and then they'll connect the call. So when a bank checks this number, they're going to call and see if anybody answers the phone. If it ring, 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 and goes to a cell phone voicemail, that's red flag. But if it goes ring, ring, and then a person picks up and say, "Oh, you've reached such and such enterprises. How may I help you today? Who you looking to speak to?" Now you have a virtual receptionist that answers the phone, and that now you look like a real legitimate person, a real legitimate business, right? And then you want to have business emails and web domains. So your emails and your website domains should match or relate to each other. Um, Again, we're not using Gmail, Yahoo's, Hotmails, anything like that. Ymails, none of that stuff. It's going to be your name at businessname.com or info@businessname.com. You can go to GoDaddy and you can purchase your website domain. Domains with the ended in .com are more expensive because those rank higher on Google and on search engines than .us or .net or whatever. You can still buy those, but .coms just more recognizable to people who are searching and more trusted because they're just more known. All right, so you go to GoDaddy and you can get those get your email domain and your website domain at the same time. All right, so the business address, again, if you don't have a commercial space, an office, a storefront, something like that, you're not going to be using a UPS, you're not using a PO box, you're not using a USPS, you're not using a FedEx box, you're not using store, none of that stuff. You're going to have to get a commercially zoned business address. You can go to anytimemailbox.com, regis.com, and there's others as well. Some use iPostal, but depending where you are, like sometimes those work well, sometimes they don't. But when you select the address, you want the address to be in a affluent business district or business area. So it could be downtown or it could be out in the suburb, or it could be somewhere where there's a office buildings or some type of business district in that area where people are conducting businesses, offices and stuff, right? And there's big corporations and businesses in that area conducting business, right? Same if it's a strip mall or something like that. Again, you want to make sure that it's somewhere where other people are conducting businesses. And um, Another note with this I wanted to say is, well, yeah, conduct the business. Yeah, I think, yeah, okay, yeah. So then, oh yeah, another thing I want to say, the banks, they're actually going to Google the address. They're going to Google it on Google Maps. And if Google Maps doesn't show a storefront, doesn't show a commercial building, doesn't show an office building on Google Maps, that's a red flag. So if they Google and they see your home address and they're Googling your house and you outside walking your dog or watering your grass, that's a red flag. You get denied. All right. So they are going to Google these addresses and look them up to see if they are at an actual commercially zoned business address where people are conducting business at, right? And then you want to go pick your own SIC and NAI CS codes. You can go on their websites and select those codes. You want to select low risk codes. I do have lists of low risk codes and highly funded codes that you guys can use. That's something that we'll go over when we're going through the process of getting funding and getting you all set up. You want to apply for your EIN. That you can do that with the secretary. Again, all of this is before you go register your business. All of this is before you go to the Secretary of State, before you go to the Secretary of State to register your business. You want to make sure that you have your website domain, your email domain, your phone numbers, uh, area code, phone number, 800 number, and fax number, your business address. You want to make sure you have all this before you go register at the Secretary of State, because this is the information you're going to give to the Secretary of State when you register your person or entity at the Secretary of State. All right. So that you can do this all yourself, or you can also you can go online. You can go to busy.com, and they'll do all this for you. Obviously, they'll charge you like a service fee, and then they'll charge you the fee that the Secretary of State charges to put all this together. You can go ahead and select the standard package. You don't need anything less than that or anything more than that, because you're going to go to GoDaddy.com to buy your website domain and your email domain. Buying your domains through Busy. If you ever stop doing business with Busy or whatever, like they own kind of own the rights to that, so they can mess things up for you. But if you go to GoDaddy.com, you buy it there, you own it. Nobody can do nothing with it, so it's best to just get the standard package, get them set up, make sure they understand how you need to be set up. They'll do all the legwork for you, and then you can get busy from there. Okay, no pun intended. Okay, and then you want to go open a bank account. Your bank account, you're going to need your articles of incorporation and your EIN number. Uh, you want to go to a national bank or a regional bank or both. Open an account on both. You want to have your website uh, created. You don't need your website done before you go register your business, but in the process of getting funding, you want to have a website or a landing page or something done. You can go online, you can buy a template, insert your brand colors, your name or whatever, put what your business does, and contact me and this, that, and the other on there. So your website is a digital brochure. It tells about, it's a digital store, it's a digital storefront, it's a digital brochure. It lets people know what you do, who you are, and where to find you and how to contact you. Um, or you can go on Fiverr. You can hire a freelancer to build a website for you. If you have a specific website, specific business, a specific way you want your website to work and operate, you can have a go on there. They'll send you websites that they build and examples of websites that they built, and you can hire them to put a website together for you. All right, and then you want to make sure you set up your social medias. So set up your Facebook business page, your Instagram business page, set up your account on X, Twitter, set up your page on LinkedIn, update your personal LinkedIn to show that, you're listing your business on there. So when they're Googling and looking this stuff up, they can find it. Again, when you're findable, you're fundable. And even if you can go also set up a business account with TikTok as well, or any other social media handles or social media apps, whatever that you're going to be using to market or whatever. But again, the more findable you are, the more fundable you are. All right. And then you also want to list yourself with Yelp and list yourself on for or with Google. Claim your business. Make sure you list yourself on Google. Confirm, verify on Google, and then also with 411. So Yelp, 411, and Google. All right. So when we're going for when we're data points and things that's going to be important on the application, which a lot of people mess up and they mess up their funding, is that the name that they put on the application. So the your own personal name needs to be the exact same name that is on your ID, which should be the exact same name that is on your credit report, which should be the exact same name that is on your articles of incorporation and in any other documents that you have. Your address, personal address should be exact same on this application as it is on your ID, same as it is on your credit report as well. And again, you should only have one address on your credit report. Your business address should be exactly the same as your articles of incorporation, which feeds through to Duns and Bradstreet, which and then other business credit report agencies also pick that data information up, and then so it needs to be the same when you go to claim your Duns and Bradstreet number. You want to make sure that all the information is exactly correct and exactly the same. If street is hyphenated as ST, it needs to be hyphenated everywhere. It cannot be hyphenated on one document and then street spelled out on the other document. It cannot be unit 20 on one document, and on another document it's number 20. 123 Main Street number 20. And then on another document it's 123 Main Street unit 20. It needs to be exactly the same across all databases, all documentation. All right. When you are, I cannot let tell you what to put as far as for income, but I can let you know how income is looked at as far as on the applications. There are exact um, data points and metrics and algorithms to get those high approvals, but that's something that we will go over once we become a client. So when we're working together, I have the exact uh, data metrics, whatever, for these applications for each product. But when you are putting your personal income, you're not putting the income that is on your W-2. You're putting the income of the household. So anybody who earns money in that house, whether it be an adult or a child, anybody, whether it be anybody who is at that house, whether they sleeping on the couch, sleeping in your basement, whatever. If they make money, that is household income, and that's what goes on to the application. Um, there are some uh, applications where there are minimum and maximum thresholds, and if you go over certain thresholds of income, they're going to ask for it's going to send it into further review. So again, um, I understand and know the parameters of where we need to be, so we know we don't go into further review. We get instant approvals for those high limits. Business income. Business income is not household; it's projected. So for your personal income, you're putting your household income. And then for the business income, you're putting the projected income, not the actual income that you're making, but the projected income for that year, what you plan on, what your business plan is projecting you to make that year. All right, so that is what you're putting into those slots. Another thing is, whether you're renting versus owning. Obviously, if you're owning, you're more stable. You get more points for that. If you're renting, but you've been renting at the same address for over 5 years, you get points for that. But owning is better than renting. If you are renting and you say that you're owning, they may ask for proof of ownership of the home. So just put the right information on there. Um, Employed versus self-employed. So when I'm looking at people's credit reports, under their employment, I do see that they put self-employed on applications, and we don't want to put self-employed on applications because that's high risk. We are always employed we are employees of our business. We're not the CEOs. We're not the bosses. We're not the presidents. We're not none of that. We are employees of that person, of that entity. I know we want to have this chip on our shoulder. We the boss, we the CEO, we the owner, we the president. No, we are the managers. We are operations managers. We manage. We are managers. We don't we're not in self-employed. We're not the boss. We're not none of that stuff. All those titles are all high risk and will get you denied. And if you say you're self-employed, they're going to ask for documentation, right? So we are employed. We are employed. That's our status. The company that we're employed by is the businesses we've opened up, and we're putting our role in as a manager. We are managing this operation. We're managing, overseeing the operations, whatever. But we're in a supervisor position. We are the managers. We're not calling ourselves owners and presidents and CEOs and founders and all this other stuff that get out your own way. That's all I gotta say. So your job title name, your occupation name also can raise red flags. So I just talked about that. So again, we're putting the right job title as supervisor or manager or department manager or operations manager or something like that, because that's actually what we're doing. All right. So prepping the application, you want to have this information ready to go. Have it on a notebook, have it ready sitting next to you when you're preparing to go to do the application. So you want to have the formation date. They're going to ask that. They're going to ask the business name. Again, make sure it's the exact same business name that is on the articles of incorporation. They're going to ask for EIN number. They're going to ask for the business address. Again, make sure the business address is correct. They're going to ask for your NAIC S code, and they may ask for the SIC code, but most of the time they're going to ask for the next code. So have that ready to go. And then they're going to ask for the business income. Again, that is the projected income. And they're going to ask for estimated monthly spend. Um, if you put like a meager number there, they're going to assume that you don't need no money, right? So you need to look at your projected income and what is it going to take to run a business for marketing, for payroll, for inventory, for everything that you need. Like that's a lot. There's a lot more than a couple grand or whatever. So your monthly spend, that data point is going to be very important. So that's something that also we will go over in our coaching session as far as what our monthly spend should be for each account that we're going to apply for, each um, credit line or credit card or loan or whatever funding we're going for. And then sometimes they may ask you for, in follow up, if anything goes into further review, they may ask you for a letter of good standing. So you'll go get that from the Secretary of State. Basically, letter of good standing is basically saying, just confirming with the Secretary of State that you're up to date on all your fees or whatever, and your person, your entity is in good standing. So these are the things that you want to have ready to go when we're going for funding. All right. So, and then when we're going for funding, there are different bank tiers that we're going to be hitting, and we're going to hit them in a certain way. They're the bigger the higher the bank tier, the less number of banks there are, and the lower the bank tier, the more lenders there are. But so you have the national banks, which is tier one. You have regional banks, which is tier two. You have your credit unions, which is going to be falling into the tier three. And you're going to have your community, local banks, fintech banks, online banks, which is going to fall into tier four. All right. And again, America has thousands and thousands of banks, which allows us to go get unseen, just an insanely amount of funding. So first, we're going to hit the tier one banks. Um, if you're building your credit out, you can go to the tier three, which is the credit unions or the regional banks, to use their products to build your credit up. But when we're going for funding, we want to hit the tier one banks, which has more of a blanketed underwriting criteria because they take applications from all over nations, from various different regions and states and circumstances and people or whatever. So they have a more of a blanketed um, application process, and it's easier for us to develop relationships with these lenders, and so we can get those higher limits that you can get as if you just go apply on your own. Regional banks, we go to those next. Those are great banks to have. Like that's why I said to open up bank accounts with national banks and regional banks so you can get into their systems and start earning those bank scores. Right. So and getting our banking tiers up as well. So we can conduct business with the national banks and the regional banks. I do not like business bank accounts or opening a business bank account to conduct business through that account with a credit union or a tier four bank. That just doesn't make sense. Credit unions, you will always need a PG. You will always need personal guarantee. They will always run your credit anytime you want to do anything. With national banks or regional banks, they can do soft pools, or they can just look at your bank rating or look at your bank score to approve you for funding. And they offer more products, more money, and higher limits. So you can get merchant accounts, you can get all kind of different accounts to support your business with the national banks and with the regional banks that the tier three and tier four banks just can't offer, right? But we still get money from all these institutions. We don't discriminate. We want the money. We want the funding, right? So we hit the tier ones, then we hit the tier twos, and then we start going down to the tier threes, and then we also hit the tier four banks, and we getting funding from all these banks, right? And this is how we can stack these things up, stack this funded up, and we can get these, you know, two, three, four, $500,000 in funding, um, in one or two rounds, right? Because there's so many banks, there's so many opportunities for funding, but again, it's the hurdle to position ourselves the proper right way to get the funding, right? So that's an example of tier one, national banks, tier two, regionals, tier three, credit unions, tier four, be community banks, local banks, fintech banks, online banks. All right. So this is a like a example of like a funding strategy or a funding sequence. This particular type of sequence is for individuals who are looking to build up their personal credit profile and funding, and also their business credit funding at the same time. So I listed here different banks that you can go to and which credit report agencies that they pull from. So one would be a credit Alliant Credit Union, which is again is a tier three bank. Their Visa signature card is a great card to go for because they'll give you some good limits on that. This is a consumer card. Then you have American Express. They typically pull from Experian most often. Sometimes they may switch up and pull from TransUnion, but typically they pull from one credit union. And most of the time, not credit report agency, but most of the time they're going to pull from Experian. But that varies depending on where you live in the country. So you have the Platinum personal card, the Platinum business card, the Gold business card, the Everyday Cash Preferred card and business card, and also the Hilton Aspire business card. So with one inquiry, you can get all these credit cards, all five credit cards. So the platinum card, personal, platinum business, the gold business, the everyday cash preferred business, or even the personal and the business, and the Hilton Aspire business. So that's five credit cards. They typically approve you for two revolving, and then you can get as many of the hand gesture. You can get as many of the charge cards as you can get. So you can keep hitting the application for the charge cards for the platinum, for the plum, for the green, or whatever else that you want to get. You want to get the personal gold and the business gold, the platinum personal and the platinum business. So you can rack those up. And then for the charge cards, you want to go and once you get approved for them, you can call in and check your spending limit on it, and they'll tell you exactly what those are. It could be 10, 20, $30,000, and you can get those limits increased. So during our coaching session, we'll go over how to do that. And then next we can go to Barclays and get the I think it's the American Airlines Aviator card. Um, you can get the personal, and I think they also have a business card as well. With Barclays, you can only apply for one credit card per day. So you can get a credit card every day, right? Until they cut you off. With Alliant Credit Union, you get, as far as I know, I don't know if you can double dip. So as far as like with one inquiry, you get one product, right? With American Express, one inquiry, you can get multiple products. In this case, you can get five products with just one inquiry. Next is Bank of America. With them, with one inquiry, you can get multiple cards. So you can get two cards on one inquiry. They have a limit on how many cards you can get within 30 days, 60 days, and I think 6 months, if my memory serves me correctly, but they do have a limit on how many cards you can get in a certain period of time. So you can do two cards now and then wait their time period and then go back and get another two cards. So with them, you can get two cards for one inquiry. So that'd be an Advantage Cash and also the Advantage Travel Business. And then you got Capital One. So you'll get the X and the Savior card. So with Capital One, they're going to pull uh, Bank of America, depending on where you live in the country, they can pull Equifax. For business products, a lot of times they pull Equifax. They can also can pull TransUnion. So it depends on like where you live in the country, but typically they'll just pull one credit report agency. And then we have and then Capital One is another reason why I don't like them is that they put an inquiry on each credit reporting agency for every time that you apply with them. So typically we like to save them for last if we're going to use them in a strategy for funding, and because they're going to put an inquiry on each credit report agency, right? So you get three inquiries total with them. So if you're going to get all these inquiries with them, you might as well get the best products that they're going to have, which is the Venture X, which is their travel card, and their Savior card, which is going to offer the higher limits on it. And then Chase, they typically pull from Experience. So you got their Sapphire card, and then also the Cash Inc. Preferred card. Now, with them, there is uh, they have multiple business cards. You can go for both of their business cards at once, or you can get their personal travel card or their which is the Sapphire Reserved card, which is like it's like a black color, and then there's a Sapphire Preferred, which is like a blue color, but the Reserve is typically has a higher, it's going to have higher credit limits on it. So if you're looking to and you can use these cards to make money off of them, which I get into at another time, but this is why we have this particular type of sequence, because we're going to use the business card for business and we use the personal cards to make money off of them. All right, so and then so you have the Cash Inc. Preferred business card. So you go for those, you get both of those products, one inquiry, and then you have the Discover Miles card, which is a travel card. Now, Discover doesn't pull all three credit report agencies, but again, depending on where you are, they randomly pull one of the three. So you'll get one inquiry on one of these three credit report agencies with Discover, right? So with that, it's just a handful of inquiries on each credit report agency, but you can get over 100,000, 150,000, $200,000 with this sequence. Obviously, there's going to be certain uh, metric data information that goes onto the application and the process to trigger them to get those high limits. But again, as we're working together and as I'm consulting with you, I will let you know what those metrics are, so you can get the best outcome. All right, so this is a business funding sequence. This is an example of business funding sequence. So this is like how we can just have five inquiries and up to 130,000, $380,000 in business funding. And the great thing about these is that any business product that you get, business credit cards and things like that, the inquiries can be removed off of your credit report. So once you build your personal credit report up, the inquiries that you use to get your personal accounts, once those age off, they're gone. But then once you go for business funding, any inquiries that goes onto your credit report for business funding, those inquiries get removed off in a process. We'll go over that process when I consult with you. So all right, so KeyBank, they offer a couple of products. You can get 100K with them. So KeyBank, you can get a business line of credit up to 50,000, and then also you can get a business credit card up to 50,000. Again, there's certain information that is going to allow you to hit those both those 50Ks and walk out of the bank with $100,000. Then you got PNC Bank, business line of credit up to 50,000, and also a business credit card up to 50,000. Typically, how this works is you would go and apply for the business line of credit, and then once you get approved for that, you get your 50K or what they're going to give you for that, and then you right after that, then you will turn around and apply for the business credit card using those same metrics, and then you get approved for that, and that's how you can get the 50K on one line and 50K on the other line, and then you can get 100K from one bank with one inquiry. All right, so then we got BMO Harris. So you have the um, business line of credit and the business credit card. Um, they usually, especially when you're first starting out this relationship, they're only going to have a threshold of $50,000. So let's say you get 25K on the business line of credit. When you apply for the credit card, they're not going to go over 25K because they have a threshold of 50,000 total. So if you get 30,000 on the business line of credit, the max you can get on the business credit card is 20,000. So that's 50K with one inquiry with TransUnion. And then Truist Bank, they have three business credit cards, and also a business line of credit. So business line of credit goes up to 50K. No doc, and all this is no doc. So this is no doc. So 50K up to 50K business line of credit with Truist Bank, no doc. And then you can go turn around and apply for all three business credit cards. Typically, they have if you don't have a prior relationship with them, they're going to cap those three approvals at 30K. They may do 10K per card or 7K on one, 13 on another, then 10K on the next one. So they usually cap it. That's what we typically usually see with clients. They usually get about 30K from all three business credit cards. But again, you can always grow those limits. So that's up to 80K from Truist Bank with one credit inquiry. And then Citizens Bank, you can go to for the uh, business credit card, and that's going to be up to 50K. Again, just one inquiry on Experian, and we will go over the metrics for that in our coaching session. All right, and then so after we go and get that money, we get it. We raise a couple hundred grand. We want to go raise more. We want to keep going. We want to keep uh, creating entities, buying entities, and keep funding them. Um, so after we hit the major banks and we get those products, you can create more entities and go back and get the same products and keep using that same funding sequence and keep hitting the same numbers. And so let's say you get $250,000 on one LLC or one corporation, you can go uh, create another corporation, follow the same compliance criteria, go back, do the same exact funding sequence with the same metrics, and you get the same results. So you get another 250,000, and now you have $500,000 that you can go invest in something. So how do we go find more banks in the area, more banks to get funding from? So for to search for tier four banks, we're going to go to bankbranchlocator.com, and we put in our zip code, and it's going to bring up all those local and small community banks that we can go into and get business loans, business line of credit, business credit cards from. And then you also got ibank.net. That's going to help you find a lot of the credit unions, which is the tier three banks. And you go open an account with them and then apply for their business products. Again, the inquiries can be removed off. And then you can also go to, excuse me, you can also go to the SBAlenders.com, and then they'll give you a list of banks that the SBA works with. And then so you'll know that these banks work with small businesses and they have business products. They have, you can call them, talk to representatives, ask them, hey, what's your lending temperature? Are you being generous? Are you on reserve? Did you work with, are you familiar with these type of businesses? Are you friendly with these type of businesses? You can literally ask them these questions, interview them to decide if you want to go in and apply for more business funding at those particular banks. All right. So then these are other options for business funding. You got equipment financing, so you can get financing, putting liens against your equipment. You got merchant advance. So this is when they look at your merchant account to see what type of money you got coming in. They give you an advance on that, and then they receive all the merchant payments until your loan is paid off. Then you have receivable factoring. So this is when you have outstanding invoices or contracts and things of that nature that are locked in, and you're providing services or whatever for them, and you're not receiving the money up front. So you can go to a factoring company, they'll give you the money up front, and then you'll sign over the payments of the invoices to that lender, and then until the debt is paid off. So a lot of times you may have to wait 30 days, 60 days, 90 days, even 6 months to get an invoice paid or chase people down and get stuff paid, right? But yeah, if you have receivables, you have outstanding invoices, things that need to be paid, you have a contract where you have recurring payments coming in, recurring services that you provide, you can leverage those to get funding for your company. And then you have revenue base. So this is more so when they look at your business bank account, your merchant accounts. They're looking to see what are you bringing in, after expenses and things of that nature, and then they'll offer you a loan or a line of credit. Most often it's a loan. And then you have SBA business loans, the 7(a) loan, and different loans from the SBA micro loans that you can go get. These typically take a little bit longer processing. Sometimes most often it takes up about 30 days. But once you get in with the SBA, they typically going to pull your Experian business and consumer report. But once you get in with them, you do good with them. You can upgrade to bigger products and more and bigger loans, right? All right. So when you're ready or for those that are ready now to go ahead and work together and get your funding for whatever you're looking to get it for to grow your business, scale your business, do business, get into investments, go into real estate or whatever you're looking to get into, buy cars, Airbnbs or whatever you're looking to get into, right? So first thing we want to do is we want to schedule a call. It'll be a Zoom call. We do like a meet and greet. This is where I ask you some questions, you ask me some questions. This call is not for people that are undecided about getting funding. This is for people that know that they need funding, know that they want funding. We're just having this conversation, one to see that, if we're a good fit to work together and if this particular type of business funding is the best type of funding for the project that you're looking to get funded, right? On that call, if the funding works out, we agree, we're a good, pair to work together. You go ahead and you make your payment online over the call. It is a one-time payment. I do not charge the 10 to 15 to 20% back end fees that other funding companies charge. I am coaching you, so you're paying for my coaching services, not for funding. I'm taking you through the process. So you're paying for my expertise, my time, and making sure that everything is lined up and that you are successful in getting funding. I'm also going to hand over all the information that I use to get you the funding. So you can go and fund yourself. You never need me again. You never need another coaching or another funding company or anything like that again. You can just reuse these same metrics to go back and get more funding. And I'll help you with the first round of funding. And then I'll give you all the information, all the numbers, everything that you need to go get the second, third, fourth round of funding. And then we will from that point, you'll sign your agreement over the phone, on the Skype call, on the video call, and then from that point, you'll be locked in or whatever, and then we will schedule your onboarding call. Your onboarding call, we're going to be going over your business compliance, make sure that you're ready in order to go. We're looking over your personal credit. Your credit should already be over 700. If it is not over 700, I mean, 680 is like the lowest, but we don't want to go in at 680. We want to go in over 700. Um, we want to go in with a couple of personal credit cards, again, over 5K or more, to get the best results, right? Otherwise, we're not going to get, we're not going to get the best results. All right, so we're gonna review your credit reports, making sure that you're all set and ready to go. Review your business compliance, make sure the business is all set and ready to go. If there's any things that need to be updated or changed on there, typically that can take, that can add 30 to 45 days onto the process, for updating in the systems of the Secretary of State or whatever we need to do. We need to change address, update things, file different stuff or whatever, get documents. That can take a little bit longer. But if you have everything in order, from the training that we talked about already, your credit is in order already. We can go right in, for I'll create the funding strategy for you and get you all the tools and resources for that funding strategy to be successful. And then I'll coach you through the process of the do's and don'ts, to make sure that you're successful, in that funding strategy. And then I'll, make sure that everything is packaged up and all that information that you use to get funded and get approved. You have all the information. You can use it to, again, go fund another entity, go fund your friend, go fund your business partner, go fund your cousin, you know, go start your own funding company or whatever. You can charge people to fund people, whatever. You can do whatever you want to do with it. It's yours. You pay for it, So that's pretty much how that goes, when we work together. So hope you guys learned, a lot from this training. You understand how to get business funding. Um, so another thing that I'm doing is I am actually, building out a community, online community. So as you, come in and you become a client, I take you through the process, go through the process of getting funded, you get your money. You're going to join an online community. This is going to be other entrepreneurs that have also gotten funded, and also are doing other funding sequences. And you can, talk back and forth with them, ask about their businesses, what they're doing, techniques, marketing, whatever, whatever you guys. This is a community of like-minded people that are entrepreneurs that are looking to grow, get money, and invest and do different things, right? So you'll be able to ask questions on there, later and later rounds of funding, or if you're looking to come back, and uh, invest in getting higher, amounts of funding or different, products for business funding. So we're going to have funding resources there. We're going to have all the metrics, all the criteria, algorithm information that we have. It'll all be listed there. We have all the tutorials, in that community. So if you forget anything or it's been a while since you funded your or had your company funded or funded your company, you can come back to the tutorials. You can see what's changed, what's not working anymore, what is working now, what new banks are, what new products are, and how we get funding from those products, right? And so you can always be up to date on what's new, what's happening. So you can always be able to go back and fund yourself again and again and again. You don't get that when you go with other funding companies. Again, they have you sign a legal limited power of attorney, which allows them to go do the applications for you. They don't give you none of the secrets, and then they charge you 10 or 15% or 20% on the back end of the money that they get you. And then next time you need to get funded, you got to go back to them again and pay another 10, 15, 20%. To me, again, I just have a flat, coaching rate, which is a flat price, and we go and get you as much money as you can handle, as you can get approved for, right? All right, and then, another thing we're going to be adding there is, how to get a good quality, um, age corporation, and also how to fund those age corporations, and, how to add automations to your business, so you can step away from your business and get your time back, and make more money. So adding those systems in, and also how to run, Meta, so that'd be Instagram and Facebook ads to drive more traffic and more revenue, to your business. All right. So that's it. That's all, folks. So you can follow me on Instagram. You can message me. I'm most active, on Instagram. So you can follow me there, message DM me there. And then that's where I do most of my marketing, most of my ads, most of my posting is going to be on Instagram. So you can check me out on Instagram. And we can go from there. You can, set up a call, set up a Zoom call, have our conversation again. When you're setting up this Zoom call with me, you already know you need funding. You're not iffy about funding. You know you need funding. Your credit is together. Um, your business is set up or you're in the process of setting up the business, again, we can go to busy.com and have that set up and ready to go within, a couple days or whatever. And our credit is strong and we're ready to get funding. Typically, funding the turnaround is pretty quick. It only takes a couple days for us to put the strategy together, go through the funding strategy, and receive the money, right? So sometimes people get nervous, whatever they want to move a little slower, and that's fine. But the only thing that would take longer than that is if we got to fix some things with the business or updates, maybe take off some addresses or names on your credit report or updates. So that may take, 30 days, for that type of turnaround. So it could take if anything needs to be done as far as preparation to get you in compliance, that can take, additional 30 or 45 days to get that done and get it reported out. And then, or if we need to add a trade line or something like that on, again, that can take, 30 or 45 days for that to report out, and then we can go and get the funding. So, but typically, if once you're ready to go, you're already set, ready to go, we can get that funding right away, like that same week. So, I look forward to working with you again. Follow me on Instagram, ISMAILKM on Instagram, and message me there, and then we'll set up a Zoom call. Again, I'll check see what type of business that you're in, if this is a good fit for you, and then if it is, we think it's a good fit, we can work together. Again, you go ahead, you make your payment, and sign your agreement. It's automatically, that be sent to you. Go ahead and sign your agreement through like a doc sign, and then we're all set, ready to go. We set up our onboarding call. We want to check out your business, make sure it's ready to be funded, and then look at your consumer credit, make sure it's ready to be funded. I personally do not do credit repair personally. I stopped doing that. It's just too much for me. So I do have someone that does credit repair. So when we going through the funding process and we need to get the inquiries taken off, they can do that for us. If you got some things that need to be fixed up and taken off, I can send you through them. That is not included in, that's separate from the funding process. So depending on how severe or how much stuff that you need to be done. So they'll go ahead and get you shaped up and everything like that. Add the accounts on, build your credit report up, add the trade lines on if we need to add trade lines to get you whipped up in shape. In that process, we make sure that your business is in compliance, ready to go, and then we go for the funding, right? So again, that's separate from my coaching. My coaching is my coaching as far as to getting you business funding. But in the event that you do need some type of credit repair or in the process of getting the funding, where we're going to remove the inquiries and go for another rounds of funding, that is separate. I can show you how to do it yourself. If you don't want to do it yourself, you can hire my partner that does the credit repair process. All right. Well, this has been great. Looking forward to working with you all. Looking forward to talking to you on Zoom. Looking forward to hearing from you. Looking forward to hearing feedback. If you learned something, if you didn't learn something, if you something that else that you want to learn that you didn't learn or didn't understand or didn't know, hey, check me out again, hit me up on Instagram, message me, give me your feedback, let me know, if I didn't explain something well enough or if you misunderstood something. Definitely let me know. I love that stuff because it helps me to help you. It helps me to help other people. It helps me to get better at what I do so I can help more people and fulfill my purpose in life. All right, so thank you guys. Thanks for coming. We're going to go ahead and end this, and that's all, folks.